Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hey, podcast listeners. Today we're doing something a little different. As the year winds down, it's always nice to reflect. And so today we're going to be publishing an amalgamation, a group of some of our top rated and downloaded podcasts of the year. Enjoy today's podcast mashup. Welcome, podcast listeners. We're in the middle of March Madness. We have an awesome show for you today. He's the founder, CIO of Seattle-based Smead Capital Management. Prior to founding Smead, he served roles at Drexel Burnham, local LA shop, Oppenheimer, Smith Barney, Wachovia, going back to my Winston-Salem days. Before starting Smead, welcome to the show, Bill Smead.
Thanks for having us.
Bill, so you're Seattle now. How's things up in Seattle? It's a beautiful day here in March, end of March?
It is. The season turned about a week ago, and I'm looking out the window at blue skies and a beautiful view of Elliott Bay.
Awesome. I love it up there. We spend as much time as I can get hopping up to the Pacific Northwest. All right, so we have a lot we want to talk about today. You're an old school value guy. Take me back to the beginning. Were you inoculated at birth like Warren Buffett, or when did you catch the value bug?
Well, I grew up in a family of what you'd call educated gamblers. So my dad grew up playing poker every Saturday night with his family, played poker every Wednesday night for 30 years with 10 or 12 of his best friends in a group called the Jolly Boys. Started going to the Greyhound races at the park in Gresham across the river in the Portland area at about 12 years old. And that was the beginnings of a life of trying to pit probabilities in your favor.
It's so funny. We talk to so many investors that have those origins. I mean, for me, same thing. My father loved poker. My grandmother loved, she must have taught me how to play blackjack. She called it 21. I couldn't have been older than 5 years old. I think that's how I learned to count and add.
My grandmother, it was Yahtzee.
Yahtzee, I loved Yahtzee. And then, the generation of my grandparents, I think my parents met playing bridge. It's not something the younger generation plays as much, but certainly some of the best investors have that history. We had Ed Thorpe on the podcast, one of kind of the pioneers of Beat the Dealer back in the day. Okay, so you got to learn a little bit about that. Was it something that you started applying in high school, university, or what eventually led you to Drexel and starting your own shop? What was the path?
So in Greyhound handicapping, there became about 5 main criteria that you were looking for. And just like in common stock selection, Charlie Munger would argue that you need to be very patient and be extremely selective. And the same is true, play good cards in poker and wait very patiently for superior odds to set up in a Greyhound race, and then bet heavily when these superior odds put themselves together. So I came up with a criteria system for selecting Greyhounds. And then I went to Whitman College in Walla Walla, Washington. I was an econ major. And my fraternity brothers and I would sit in the TV room a lot on Saturdays and Sundays watching games. And when I was a junior, one of my best buddies looked at me and goes, you're so opinionated, you ought to go in the investment business. And that was a pretty good thing for that guy to say, because his grandfather ran the most successful brokerage office in Seattle in the 40s and 50s and 60s. And then secondly, my best friend's girlfriend, her dad was the manager of the Drexel office in Palo Alto. When I was a senior, I sent him a resume and a letter that his daughter helped write. He passed it forward to the Seattle manager, and I got hired straight out of college. And we graduated on the 25th. Mount St. Helens blew up on the 18th of May. I graduated on the 25th of May, and I blew into Seattle on June 2nd and started working at Drexel Burnham.
I love it. And so you eventually started your own shop with stints at Wachovia, which is a name that has a lot of fond memories for me. I grew up partially in North Carolina in Winston-Salem. What led you to start your own business? You said I'm ready to do this on my own?
Yeah, so I started out as a stockbroker / financial advisor, and then in 92 was at Smith Barney when they started the program for running separate accounts. And they had us all go through getting an RIA shingle, taking a test and getting licensed to be an RIA. And I was one of the first people they invited into that program. So at the beginning of 93, I started the process of doing nothing but running separate accounts where I was picking stocks. That's what I did from 93 until the summer of 07. And we were tracking how we were doing as compared to the mutual fund managers that I admired the most, and found that our numbers were stacking up quite well. And my wife and I had 5 children, and they were all good athletes, and so we entertained ourselves and never missed a practice, never missed a game, running that private client separate account business. And then the youngest daughter got to be 17 or 18, and she was an outstanding athlete, but she decided she was more interested in boys than she was in softball. And so that was the point at which it's time to go out in the public domain and put your stock picking skills to the test against the other people that have got their neck stuck out there every day.
Well, 2007 would have been certainly an interesting time to be doing that. I'm fairly familiar with your process, but you talk about, I'd love to talk about your framework, and then we'll start to get into some themes and potentially some ideas on the way the world looks. But lay the groundwork for us. I've seen you mention that there's 8 things you're typically looking for as you think about investments. You want to give us a broad overview of how you think about finding opportunities?
Yeah, let me take you back in time, and hopefully I won't make the listeners feel too much like I'm the guy in the song, I got a king-size bed and a PhD and the way things used to be. So when I got into the investment business in 1980 with an economics degree, I knew just enough to know that those high double-digit interest rates were likely a once-in-a-lifetime opportunity. And so the first 10 years that I was in the investment business, 80% of the money I looked after was in fixed income at rates of return that you normally had to buy equities to get. And then you dabbled on the side in the stock market and you read. And so I was lucky enough to, in the 80s, to learn about Buffett and read everything there was there, read everything Peter Lynch wrote, read Phil Correa and Phil Fisher and John Neff, and read Peter Lynch's books and so forth, and then have some life experiences that cause you to get scars, and those scars and those great investors that preceded us led us to 8 criteria for stock selection, which were things that we felt were demonstratable. Each one of them individually is not that important, but in totality, the 8 criteria are like a checklist for getting in the cockpit of an airplane and Boeing having the right software. So that's where our 8 criteria for common stock selection came from. But remember, it kind of matched up with the way we were selecting greyhound races, which was by 5 key criteria in the greyhound race. And so once that came together, once that common stock selection criteria came together about 1990 or 91, that was the beginnings of being able to run a concentrated, high-quality portfolio, first as separate accounts and then as a fund in separate accounts.
Would you mind kind of fleshing out, you don't have to go through all 8, you can if you want, but maybe...
I'd be happy to. You know, the book about Danny Kahneman and the other brilliant guy that kind of created the behavioral finance thing, there's a section in there, there's a guy that wants to improve a medical system up in Toronto. And one of the things he did is he took like 400 anesthesiologists and asked them what they were looking for at an X-ray to determine whether someone had cancer. And then they created a computer program out of the criteria that the 400 anesthesiologists gave them. And then they took 500 random X-rays, had those 400 anesthesiologists tell them whether they thought the X-ray had cancer or not. And then they ran those 500 random X-rays through the criteria that the 400 anesthesiologists had come up with. And the computer did a better job of getting it right than the people that came up with the criteria did. So the first thing to understand is the criteria that we're operating under is more important than any feelings or eyesight checks or anything. So first of all, and I know this sounds ridiculous, but think of how much trouble it saved us in 1999, and think of how much trouble it would save you on all these money-losing unicorns going public. And that is, first of all, does it meet an economic need, right? And I know that sounds simple, but it's important. The second thing is, does it have a long history of profitability? Mike Trout got signed to a $430 million contract. Why? Because for 5 or 6 or 7 years, He's been clearly the superior baseball player in all of Major League Baseball. And what that's saying is that you're not looking to invent the wheel. See, we're at the end of 10 years of growth, stomping value consistently for almost 10 years without any interruption whatsoever, to a magnitude that equals the outperformance from 95 to 2000. So it's the same magnitude. It's just built constantly for 10 years. In that kind of an environment, people look, and they're not afraid of risk. I think Howard Marks did a great job of covering that for you in your conversation with him. They're not afraid of risk. The price of money is incredibly low, which means the opportunity cost is incredibly low. And so we are not here to invent the wheel. We are here to wait until a wonderful business that has been outperformer over the last 20 years compared to the S&P and a company that fits our other criteria, and buy them at a point in time when they're out of favor. Third thing is they must have a wide moat. And wide moat is not something that people at Morningstar can create a mathematical formula for. Buffett and Munger talk all the time about the fact that you probably know all the math you need to know to be a great investor by the time you finish 7th grade. And every IQ point above 125 is probably detrimental to your ability as a stock picker, because these things are not complex. They're just hard to execute. So wide moat. Wide moat means a child is born in the United States regardless of socioeconomic background, and they're immediately a customer of the Disney Corporation. It's a virtual guarantee that that child will go to Disneyland in the first 10 years of their life. Whether it be a relative sending them or the local charity sending them, somebody's going to send them. They're going to be a Disney customer. We're a nation of 60-year-old people that are starving for their first grandkid. The spoilage is going to be legendary, and the parents and grandparents are just dying for them to get old enough for Disneyland to be useful to them. It's just crazy. The moat at Disney is unbelievable, and then the fact that they take something that was made 90 years ago and resell it. Oh, they don't have to draw Mickey again. And they just keep selling Mickey. I mean, it's just an incredibly profitable business. So wide moat. For example, we're buying and own the home builders. The moat in home building has exploded in the United States in the last 10 years. The market share of the publicly traded companies is growing immensely, and they have the best setup to deal with limited carpenters, limited plumbers, limited framers, all the tradespeople. If you're a tradesperson and you can go to a place that Lennar's building 150 homes, you can go to work in the same place every day for a year, you're thrilled. You don't want to go do a one-off or a two-off at some mom-and-pop builder. And besides that, the tax code now penalizes a $2 or $3 million home and is all set up for a boom in $500,000 homes. Next, does it generate high and consistent free cash flow? We own NVR. They generated positive free cash flow in 2008 and 2009 as a home builder, and 10 and 11. In 2011, in the United States, we built 320,000 new single-family homes. We had about 315 or 20 million people in the United States that year. And in the 60s and 70s, where we ranged from, say, 175 million people to, say, 200, the worst recession year, and there were some nasty recessions, and there were some terrible things happened in the Vietnam War and race riots and all kinds of horrendous stuff were going on in the United States. The worst year of building homes was 550,000. So 2011, we built 40% fewer than the worst recession when we had, 40-45% less humans in the country. It's just crazy. So generating free cash flow through that misery was remarkable for NVR to do that. We need to be able to buy at a bargain price in relation to the prior 5 to 10 years when we initiate our position. We're looking for a bargain. We're looking for not only a great setup from an economic standpoint going forward 5 to 10 years, but we want something that at the time we buy it is very much out of favor or misunderstood in relation to what the future success of the business is going to be, right? We're trying to buy the most future success for the least amount of money. And then the other three are we want businesses that are shareholder friendly. Just to use NVR and Amgen as a couple of examples, Amgen has swallowed half their float in 15 years, and NVR has swallowed 75% of their float in 20 years.
That's a phrase that Charlie Munger says, looking for the cannibals, or the companies that kind of eat themselves. Some people will call it shareholder yield, but certainly that reducing the float has historically been a monster factor for outperformance. Okay, keep going. Didn't mean to interrupt.
And honestly, I am very frustrated and kind of unhappy with Buffett and Munger, because that's exactly what they should be doing with Berkshire Hathaway right now. If they owned a company that was in their situation, they'd be banging on their door every day. What are they doing? Eat your own cooking.
Yeah. Let's talk about that for a second, and we'll hop back to the list of 8. Most of my conversations are like this. They bounce around all over. But I know you are a frequent Buffett commentator. I saw some comments you made about the recent letter. Maybe elaborate on that point, because it seemed to me like Buffett was laying the groundwork a little bit for saying, hey, we might be buying back some more stock aggressively in the future. He used to have some sort of floor on price to book, but it seems they removed that. Talk a little bit more about that point, and then we'll get back to the 8 criteria.
Yeah, I'll answer this quickly. My answer to why they're not doing that is Warren turns 89 this summer, and Charlie's a lot older, and I think they want that stock buyback gun so full the day one of them dies that they can just start firing. I think that's the reason. Now, why they don't just tell us that, they'd be mad at a company if they didn't tell them that. It's okay to do it. I understand why they would do that, but tell us, right? Okay, so back to shareholder friendliness is what we're talking about. So we owned Amgen in the summer of 11. And by the way, it's like the media that follows the stock market just needs to call us and listen to us. I remember talking to journalists of the major publications at the time. Amgen started their dividend in the summer of 11. They paid 28 cents. Their stock was at 52, 28 cents a quarter. And that annualized rate at that moment in time was higher than the 10-year Treasury. Now, how many blue chip companies that are in the S&P start a dividend at a yield higher than the index? And the answer is, I think it's the first time it's ever happened. And who reported that? Nobody. Do you know they're paying $5.80 this year? We're getting 11% return in cash from dividends after tax, after their taxes and stock buybacks, and 16% spent on research and development on a pre-tax basis. We're getting 11% from that purchase in the summer of 11. And people wonder why I like hanging on to the stock. Okay? So next, strong balance sheet. And boy, when the worm turns here and the price of money rises, the balance power in the common stock market is going to shift from revenue growth stories to strong balance sheets and high and consistent free cash flow. In other words, as capital becomes more expensive, the companies that use their own capital internally and don't require outside capital will trade at premium price earnings multiples to the people that have to go to the capital markets to get money. I've been around 39 years. I know how tough it was to find capital in 1980 through 85, right? I mean, Milken was a genius because he unlocked the door to very large corporations with less than A ratings to get access to capital. And we're at the absolute dead opposite of that spectrum. So the balance sheet's very, very important. So I have 2 co-portfolio managers, and they're both very strong. And I mean, literally, it's like the 8 criteria and me are to the company as the criteria the anesthesiologist came up with, are to determining whether people have cancer. Tony Shear, our director of research, and Cole Smead, my oldest son, they've been here for the last 11 years on the fund, which, by the way, started the second trading day of 2008, and the first 14 months of employing that strategy in a fund was the worst 14 months in 86 years, if anybody out there is wondering if we're good market timers or not. And the answer is we make no effort to market time because we can't. So anyway, so back to the insider. So I've often said that if I only had one of our 8 criteria, the one that I'd want is strong insider ownership, preferably with recent purchases. and I could run you through the list. We own J.P. Morgan because the whale trade hit J.P. Morgan in 2012, and Jamie Dimon bought $13 million worth of the stock at $34.50, and we couldn't follow him in there faster. I worked with him for 11 years at Smith Barney. Admire him and think he's an outstanding manager of that business. We were buying Bank America in early 12. The insiders were loading up, and the stock was depressed, and we figured out that we were paying about $20 or $30 million for the largest deposit bank net of what Merrill Lynch was worth, which they bought at the height of the financial crisis. And we see that over and over again. If the officers and directors of a company are calling up their broker to buy, like Peter Lynch said, there's 50 reasons to sell, and there's only one reason to buy. Or how about this? Last 12 months, Amgen, which has now been trading, I'd say the last year between about 170 and 210, there was $5 million worth of insider sales at Amgen the last 12 months. It's a $120 billion market cap company. It's like, there's always somebody that needs a new house, or there's always things that are going on. They must have dozens of insiders there, and they're headquartered in Thousand Oaks. It's not cheap to buy a house close to their headquarters.
I was a biotech engineer in a former life, and one of my first interviews out of college was at Amgen in Thousand Oaks, and I spent an entire day there. Didn't go work there, but certainly have some memories from hanging out in Thousand Oak. And it's funny because I actually asked a lot of the young people that were there. I was in my early 20s at the time. I said, "Where do you live?" And half of them said they lived in Los Angeles and commuted an hour a day. And each way I said, "Oh my God, I can't do that. I'll go crazy after about a week." So it's funny, brings back some memories.
Well, no, that's right. And so the lack of insider selling at a company that side almost works the same as insider buys do on smaller companies. John Malone bought $32 million worth of Discovery, most of it at $23.50. The stock's trading today at $26.50 or something. Does John Malone buy something a year ago to make 10 or 15%? It's just crazy. It's just crazy. 25-year-old women that use cable television, the two most popular things for them to watch, which, by the way, it's a pretty good chance it's going to be part of Discovery because they are 50% of the viewership on cable TV. The number one is HGTV, and the number two is 90 Day Fiancé. Now, if you don't think that's a ticket to the American dream, you 25 to 35-year-old males out there, you're on the wrong dating site.
That's funny. Let's take a quick break for a word from our sponsor. Ski the world's best destinations this winter with a Mountain Collective Pass. Pass holders get 34 days at the best ski destinations across 4 continents, plus half off all additional days. No blackouts. In total, the Mountain Collective Pass provides access to over 57,000 skiable acres, 6,200 inches of annual snowfall, and 361 chairlifts. You'll get 2 days at 17 world-class ski destinations. Head to mountaincollective.com for more info. And now, back to the show. All right, so the process, if I was to distill it, is a very thoughtful one. It sounds like a value approach with quality, with insider ownership, and a strong balance sheet, and a history of shareholder friendliness. I mean, that is a pretty robust screening criteria. As we talk about implementation and cycles, you made a thoughtful comment starting the company in the global financial crisis, but following since, I think a lot of traditional value factor strategies, whether it's quantitative or whether it's Buffett or a lot of people, this past cycle seems to have been really characterized by a lot of growth in those sort of investments. You had an interesting recent piece where I'm going to read a quote, and then we can kind of use that as a jumping off piece called "We See Dead Stocks," where you said, "Financial euphoria episodes are a common occurrence in investment markets in the U.S. stock market. When a new one comes along, market participants accelerate their enthusiasm toward the end, which makes the shares of companies involved dead to us. The new mania becomes comparable to prior episodes and prepares to destroy the capital of those who extrapolate the existing trends and enthusiasm." Maybe elaborate a little bit about the landscape today, kind of what you're seeing. Are you seeing a ton of opportunity for investments? Are you seeing a little more challenges in finding stocks? And then go off into any number of tangents from there.
You're inviting me into about 4 or 5 of my favorite subjects at once, so let me handle them one at a time. First, we have a chart that goes back 45 years that shows that the e-commerce parabolic move is the third biggest parabolic move of the last 45 years, only behind the dot-com bubble, and not very far behind it, and only behind the ridiculously stupid 03, 04, 05 residential housing stupidity. Okay? So anybody that thinks, that's owning these things, that doesn't realize that at best we're in the late stages of a parabolic move is kidding themselves. Now, we have so many charts right now that show the similarities between now and 99 that we're starting to get depressed just looking at them. For example, just one example, by the end of September of last year, the year 2018 had broken the record for money-losing companies going public, over 99. Right? Everybody says, oh, no, this is not nearly as bad as 99 because Facebook and Google have earnings, yada, 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 right? And now, if you can trust what they're showing in their numbers, Amazon is showing free cash flow and profits, if you can trust their numbers. Their offices are 10 blocks from here. We get to see them up close and personal. So they say it's not as egregious. But you know what? The appreciation of the common stocks involved in a lot of cases breaks the Cisco, Intel, Microsoft, Sun Microsystem, Lucent Technology record. When you see a bankrupt company named Levi Strauss go public and jump 30% the first day, when you see Pinterest read the tea leaves and their investment bankers read the tea leaves, go, we better hustle. Lyft, we better hustle. $2 billion in revenue, $991 million loss, better hustle. The cheap capital is going to go away soon. You got to get there. You got to hit the bid. Uber, every one of those. I mean, I personally think they're all fools for not already going public. But what that's going to do is massively dilute where the growth people are going to go with their money. Cole made a great comment this morning. We were talking. He said, what percentage of the advertising that's done on Google right now is from businesses that are actually making a profit running the ad? Right? Every Grubhub, Drop Dead, whatever, you name them, all these delivery companies are losing their rear. By the way, the definition of insanity is doing the same thing over and over again, expecting a different result. Give me the list of everyone that's made a profit delivering groceries.
Yeah. Webvan, right? Come on.
Webvan. By the way, that is to this day the worst corporate executive career move in the history of the United States of America, when George Shaheen left Anderson Consulting about 4 years before they went public to be the CEO at Webvan, which 2 or 3 years later was completely gone. His Accenture shares would have made him a multi-millionaire. It's the worst trade in history. So we're here in Seattle. There's like 4 or 5 main arterials into downtown. The one from the north goes up to a neighborhood called Ballard, and it crosses the Ballard Bridge. And on the other side of the Ballard Bridge, as you head from downtown north, was a great Chinese restaurant, Larry Louie's restaurant. And they had the best coconut shrimp, but the Louie's gave up and closed it down about 5 or 6 years ago. So sure enough, that is the Amazon Fresh location. It's a very busy street. I mean, during commuting times, thousands and thousands of cars go by there both directions, in the morning, in the evening, and all day long. So I kept going by there because I've got grandkids that live north, so I keep driving by there all the time. And during the first 6 months of the beta test on the thing, we noticed, I mean, if there's 2 cars there, it seems like a miracle. 1 car is probably 40% of the time, and no cars is 50% of the time during the first 6 months. And now we're like a year and a half into it. So partway into that beta test, 6 months into it, Amazon announced that they're buying Whole Foods. Now, my problem is I've been around way too long. And I know that John Mackey was the guy that went in chat rooms in 1999 on AOL, which, by the way, was the most popular stock of that particular era, and was in control of everything associated with the Internet in 1999 when the movie You've Got Mail came out, and went into chat rooms to smear Wild Oats and other publicly traded organic grocery store companies so that he could acquire the company cheaper, and got caught by the SEC. Basically, he was the Elon Musk of back then. So that's who they bought, because the Amazon Fresh beta test wasn't going well, and then told people that they gave them a completely different reason for why they bought it. And we were sitting right here and knew exactly why they bought it, because that was going to be DOA, because the definition of insanity is doing the same thing over and over again, expecting a different result. So the point of all this is there is a mania in e-commerce. It's been a massive parabolic move. We have no idea when it ends. We do not have that kind of ability. All we know is that every single incident like this 10 years later has been nothing but heartache. Nothing but heartache. Coca-Cola and Disney were the Amazon and Netflix and Google and Facebook of 1972. 80 times earnings on Disney, 80 times earnings on Coca-Cola. Coca-Cola owned Columbia Pictures in the late 70s because they thought it was a good idea to go into the movie business. Does that ring any bells for everybody listening out there? And we're trading at 6 times earnings, paying a 5% dividend when I got my brokerage license at the end of October of 1980. It's the first stock I pitched. I pitched it about 100 times in the next 30, 40 days after I got my license. My dad and my cousin were the only 2 people that bought it. I thought, you're going to starve if you're going to try to open accounts with this stock, and went on to another project. Buffett paid 6 times that price in 89. So it went from 80 times earnings to 6 times earnings. And Disney went from 80 times earnings to 10 times earnings, even though nothing got interrupted about the attractiveness of the Disney Corporation. So I love people fawning all over these stocks because they're going into Hollywood.
Just real quick, it's a great example. I think a lot of investors have a hard time separating a business or a company from the stock. And so you could have a great company like Disney where sometimes it's priced attractively and sometimes it's not. If you go back even further, there's a great research white paper by Professor Schiller that looks at sector valuations throughout history, and he talks about how utilities, the most boring possible sector on the planet, as a sector hit a P ratio of like 60 in the roaring 20s. And so the names change and the stories change and the sectors change, whether it's electronics or plastics or .com or today a lot of the e-commerce stocks you're talking about. But I think we all know, maybe not my millennial listeners, but the older gray hair and no hairs listening certainly know that paying PEs of 50, 80, 100 plus historically has not been a good bet.
It's a death ticket for your capital. So Buffett, in his most recent letter, I love this. It's like, why don't they just let me come on and ask the questions when they have him on TV? So Warren wrote in his most recent letter exactly what you just explained. He said, a very good company that's going to succeed as an underlying business for decades can trade at a price that either cause permanent damage to your capital or at a minimum so much damage for so long that you'll never stay with it. He put that in there, and no one asked him about it. Not a word. No one asked him what he was talking about. And you got Charlie Munger out there who sat on the board of Costco for a long time, and so thinks that everything's going to be another Costco, and he says, gosh, all I can say is Amazon is a force of nature. Are you kidding me? If the chairman and CEO of one of the companies that we own did what the chairman and CEO of Amazon did, our stock would get pummeled. I mean pummeled, right? Pummeled. And it's like, what has happened out there? I mean, you know, the Bible says that there'll come a time when right is wrong and wrong is right. And then I saw a guy that I respect a great deal that I won't name wrote a piece recently that maybe price-earnings ratio doesn't matter, and maybe all these things that are cheap. So here's the breakdown. You've probably seen it in some of our writing. We have a setup for breaking the S&P down into the 5 PE quintiles, like David Dreaman's book when he wrote it, 30 years ago or whatever. Anyway, so right now, the cheapest 100 stocks in the S&P trade for about 8 times earnings, and then the next cheapest 100 traded about 12 or 13, and then the middle ones traded just a little over the market multiple at like 18, and then the next one up is like, I don't know, I'm not looking at it right now, but say 30, and then the 100 most expensive trade at 94.8 times earnings. The only time, I'm not talking about all the rest of recorded history. The only time in the Ibbotson that you can find that would have been the last 6 months, or maybe the first few months of 2000 and the last 6 months of 99. It's the biggest bifurcation, and since it's taken so much longer to develop, so now you've got really well thought of, excellent stock picker portfolio managers, and their will is being bent to the circumstances.
We'll definitely have to link to your piece in the show notes, listeners, mebfaber.com/podcast, and some of these writings. That's a very sobering statistic, certainly. And you've also even written a little bit about some of these tech companies and possibility. We've seen it quite a bit with rumblings and from the politicians starting to talk a little bit about antitrust and other concerns, not to even mention a lot of the mood shifting about data and privacy and those sort of ideas. But feel free to keep going down the path I interrupted you on, or you can chat about that article too.
George Gilder's got a really good book out called Life After Google. Let me explain this two different directions. First of all, the primary mechanism for balancing supply and demand in a democratic capitalist society is the price of the good. So we have what we call the three identical strangers, which if you haven't seen that documentary, it's fantastic. The three identical strangers are Facebook, Google, and Amazon, because they both give the main thing they do away for free. Free social media, free search, and free delivery. Now, that is guaranteed to distort the democratic capitalist system because it virtually puts anyone that could possibly want to compete with them at a complete and total disadvantage. So now let me shift gears to explain to your listeners what is wrong with the system at the moment. When I moved to Seattle, I played 1 year of Division III college basketball. I had a blast, made great friends. I'm 5'8" and a left-handed point guard, and the physical challenges stopped me from continuing on, but I love basketball. So when I came to Seattle, I was a single guy, and Saturday morning I'd go down to Green Lake, and there was some of the best pickup basketball games in town down at the playground at Green Lake. So I'd go over there for about 5 or 6 weeks in a row on Saturday, and I'd play. And then about the sixth time I played, when you play pickup basketball, there's no referees, and the players themselves are the ones that call the fouls. And it's a virtual guarantee, if you play for 2 or 3 hours, that there's going to be a fight when somebody calls a foul that the guy that fouled didn't like. And I realized about the sixth time I played that I was the only guy playing that had a job. This was the summer of 1980 when unemployment was 10.5% and the prime interest rate was 20%. And I said, you know, Bill, you probably shouldn't play in this game because you're the only one here with a job. Now, that is where we are with Facebook, Google, and Amazon. They are being allowed to officiate their own games and then spending millions and millions of dollars to control the body politic in a way that will allow them to continue to be the referee. So here's the problem. The problem is that under antitrust laws that were written between 1900 and 1920 to protect consumers, it does nothing to address what is going on there. Because a thing called the internet, which Katie Couric didn't understand when it came along, had not yet been invented. And there is the ability to aggregate power in business on the internet in a way that no one back when those laws were written could vaguely have imagined. So the first thing we need to do is to rewrite the laws. That's the first thing. The second thing we need to do is apply the laws, and here's how it works. You are, let's just use Google as an example. So my wife and I own a condo 2 miles from the office, overseeing Elliott Bay, about 5 blocks from what used to be the Amgen headquarters, and next fall will become Expedia's headquarters. So I thought, I'm going to keep track of Expedia, not because I'm interested in paying that kind of multiple for the stock, but because if I ever go to sell this condo, I'm probably going to sell it to an executive of Expedia that no longer likes commuting from Redmond, Washington to downtown, which is a nightmare during rush hour, both directions. So I get their annual report. This is maybe a year and a half, 2 years ago. and it says they did $9 billion in travel commissions. And then I go over to their expense list, and the number one expense of that corporation is paying Google for advertising. And then I went over to Google's annual report, and Google did $12 billion in travel commissions. Now, it is ridiculous that the people that know everything about everybody by giving away free search and know everything about the interactions between Expedia and the clicks should be doing business head-to-head with their customer. You know, I think if you look that up in the dictionary, you'll find it under schmuck.
Yeah.
Okay, now that's just one example. How about this? How about more than likely the single most profitable thing that AWS does is web host the porn industry? And what if you could lose money delivering all this stuff because you're being subsidized by that? What if the two largest customers of Amazon are the porn industry and Amazon e-commerce? And they're losing the money on the one side so they can build up the money they're making on the other side. What if you're Facebook and you're giving away social media and people aren't like Bill Smead, who wakes up a year and 3 months ago and says, wait a second, why am I working as an unpaid actor or actress for these guys? They're not giving me a very good return. So I looked and I said, I don't want to be Bruce Almighty. I don't want to get 6 million prayer requests. And number two, I don't want somebody tracking me everywhere I go. And number three, I don't want to intensely dislike friends that I have because of opinions they put there that are just so, I just think, regardless of whether you come down to from a political standpoint, you've got to express yourself in a way that's conducive to ongoing civility. So anyway, needless to say, that's just some of the privacy and all that. It's just, there's no officiating because there's no rules. They're letting the prisoners run the prison. It's as simple as that.
So we've touched on a few things, and there's a couple other themes I want to hit on. We've certainly talked about where we are in the cycle and some of the challenges and the things to avoid, largely expensive companies as well as some of the tech and e-commerce. You mentioned at the very beginning, and I would love to kind of come full circle and actually touch on a few of the ideas or themes that you think are worth allocating our hard-earned dollars to. One of the things that you briefly mentioned, and I'd love to hear you expand a little bit more on, is this concept of demographics and millennials, their kind of growing role in the economy. Thoughts there?
The group in front of the baby boomers at its peak number of population was 44 million people. So you can pretty much track the United States economy this way. When the boomers moved into the 30 to 45-year-old age bracket, which is the borrowing age in the United States, that's when you take out the biggest mortgages in your life and the biggest car payments and all that kind of stuff. When 79 million boomers replaced 44 million silent generation people in between them and their parents, just think about it. What happened to the price of money when you had 35 million more borrowers than the prior era? Skyrocketed. That's what made the 20% prime and the 15% treasuries. So then, after that got over, the baby boomers replaced those 44 million people in the saver age from 45 to 60. So we had 35 million more savers, and the group behind them was 65 million. So we had about 17% fewer borrowers and 75% more savers. What's happened to the price of money? And the answer is, now we got 2.4 something 10-year treasuries. But what's going to happen next is the group behind the Gen Xers is already 89 million strong and will be 95 million at the peak because their age group is who gets to work for businesses. And so we, over the next 10 to 15 years, are going to add the equivalent of all the 30 to 45-year-olds in Canada, England, Ireland, Wales, and Scotland on top of the 65 million Gen Xers that we already had into the highest multiplier effect part of the United States economy. This is the antithesis of the last 10 years. So let me just stop and address that last 10 years. The last 10 years was about millions of 20 to 30-year-old, well-educated people making above average income if they had a college degree, which a lot more of them do than prior generations, living in expensive coastal cities, drinking craft beer, eating fast food, and buying iPods, iPads, and iPhones, and paying rent. Now, if you dig into the economics behind those activities, you'll find there was zero multiplier effect. The iPads and iPhones were assembled in another country, and nobody that wraps Chipotle burritos or Shake Shack burgers can afford to buy anything else other than a bus fare. And then the people that were the bartender at the craft beer place in these expensive cities, all they can afford is to pay their rent. So there was no multiplier effect, and Seth Rogen played 26 to 27-year-old characters who were drunk and stoned, sometimes living in their parents' home, and we laughed our guts out because we were going to cry if we didn't. Okay? That's what the last 10 years is about. Therefore, you wanted to own the companies that benefited the most from 26-year-old single people. And that's what did the best. Amazon, Netflix, they're young and poor. And maybe they do want to spend the rest of their life doing nothing but watching The Office, which NBC never should have sold to Netflix in the first place. By the way, the guy that runs the New York Times came out today or yesterday and said, hey, we're not going to put our newspaper in Amazon's news feed. Wall Street Journal's agreeing to split 50-50. You got to control your content. Okay, so start following 35 to 40-year-old parents of 2 or more kids around for 5 or 6 weeks and track where their money goes. Because over the course of the next 10 years, that's going to be what it's all about. And Mark Wahlberg is on the cutting edge of it. He made a movie called Instant Family. And even Seth Rogen is married now and living next door to a fraternity or a sorority. Now, he doesn't know enough to not say terrible things around children, but he hasn't quite got there. Okay? So that is where the puck is going to be, Wayne Gretzky would tell you. And the way investors operate is they actually want to be perfect at their time in getting involved in that, but I can tell you it's a tsunami. The United States economy is highly likely to be the strongest the next 10 years it's been since the baby boomers went through the 30 to 45-year-old age range. The household debt service is the lowest it's been in 40 years. The savings rate's the highest it's been in 40 years. All the preconditions of that levering up are in place. And then as if the millennials are not spoiled enough, not entitled enough, and not coddled enough, we just had the Federal Reserve take the mortgage rates back to 4.3% just to make sure that they've got the best borrowing rate that any generation has ever had to buy their houses. And the people on TV think I've lost my marbles for thinking this. In some ways, if we were all 25-year-old young men and women, you just want to start a home builder and go to Albuquerque or Omaha or Kansas City or Laramie or Indianapolis or Detroit, where all these people are going to ultimately move, because money goes where it gets treated the best. And people are making the assumption that this massive number of software engineers and computer science and coder people that are living the high life at 28 or 30 and making $100,000, that they're going to wake up in 10 years and they're all going to have done a startup, or they're all going to be in management. And you know what? In 10 years, they'll be lucky if they're still making $80,000 or $100,000, and they're going to be begging their company to move them to a place in the country where that money goes twice as far so they can take care of their family.
Having traveled around the country, you're seeing that trend really accelerate. Having spent time in places like San Antonio, where I said, my God, the crane indicator of this town is booming. And they said, look, Austin is spilling over. There's too many young people moving to Austin. They're all having to move to San Antonio. And you're seeing it in a lot of places kind of around the country. And it might actually be fuel to that fire, and it remains to be seen because it's still getting drafted, but a lot of the legislation around opportunity zones and funds and investing could actually spur that development even more. It will be fun to watch.
One of the investments that I was too young to understand to hold on to in the 80s that I owned and sold it way too soon was public storage. If you could close your eyes in 85 and know one of the most popular cable shows was going to be Hoarders, you'd have realized, and Storage Wars, that people just get more junk all the time and they never throw it away. It's very difficult for people to purge, and it's real easy for them to add more junk, right? Well, Wayne Hughes is the guy that started that company, and he's now got a new company called American Homes for Rent, and he owns about 52,000 homes, many of them brand new when he buys them, and he's renting them to people. Because that can be kind of a transition. You know, if you've been living in an apartment, you get married, and you're not really sure that you want a home, you might rent a home for a while to see if it fits your family the way you want it to. Of course, as soon as you do that, after about a year, you realize, hey, I'd rather, the home builders and the banks and these other people are doing a terrible job of reminding people that for the average family, the average 35-year-old couple with a 2- and 4-year-old, for most people, the largest accumulation of net worth in their life, other than maybe their 401k plan, will be the forced savings plan called a home. And then all the utility that you get from it, and then all the studies show that the kids do better growing up in their own. It's just crazy. So, yes, it is absolutely crazy. So we like the home builders. Home Depot, it's like, are you kidding me? Why is there a 10 PE spread between Costco and Home Depot? Why is that? It's not like people are going to spend more. I mean, they will spend more at Costco, but on the margin, the honey-do list is going to explode, just explode. And so we saw a big jump today in existing home sales, 11.8%. Diana Olick was shocked on TV today because she'd been leading the campaign on slowdown in housing, and she says it's because of affordability. Let me give your listeners a quick lesson on what affordability means in housing. So houses in the last 60 years were the most affordable in 2010, 2011. We built the fewest homes in 2011 in 60 years. So what's the correlation between affordability and home building? The answer is nobody builds a home when no one wants one. Now, other than the ridiculous 05-06 peak, you have to go back to the mid to late 70s, where there were two peaks, one in the early to mid and one in the late 70s, and then the early to mid 80s were the three big single-family home building peaks when it was the baby boomers that were in the key demographic age group, when we had 200 million people instead of 330 million. So once these tech companies get done with their arrogance and building their ridiculous buildings that they're building that is definitely topping the cycle out, just like the Empire State Building did in 1929-30, Devon Energy's building that finished in 2008 did to oil and gas, and I could go through the list, kind of thing Howard Marks would have talked a lot about on your podcast. Once they get done with that, and they find out, hey, let's take 10,000 of our employees and move them to Indianapolis. It's got a great airport and homes trade for 40% of what they do in these expensive cities. Live happily ever after.
You know, this is certainly hitting pretty close to home. I live in Los Angeles, in Manhattan Beach, where I can't even fathom the average home price here is just bananas. And so you're speaking the exact demographic where, as a parent to a 2-year-old and a partner to a wife who is very incentivized to become a homeowner, I look towards greener pastures like my family in Denver and other places and shake my head at craziness here. So this is all very close to home.
What is the most likely TV show for a 35-year-old woman to watch on cable? Fixer Upper. Okay, who advertises on Fixer Upper? Target and Home Depot. Let's talk about Target. The idea that everyone's going to have all their stuff delivered to their house has never met the mother of a 2- and 4-year-old or a stay-at-home dad with a 2- and 4-year-old who have a choice of being stuck at home constantly during the work week, or they can take a 2.5-hour break by putting the kids in the car, talking to another adult while they're sleeping in the car, go to Target for the 3 things they need and the 3 things they don't, going to Starbucks after checking out, taking the kids over to the fast food place, probably McDonald's, putting them on the playground, buying them a Happy Meal, and 2.5 hours later getting back and completely causing sanity that a cardboard box being delivered by a USPS person who the government and the taxpayers are losing money on delivering it to the door. And I don't even want to go into that because that just makes me mad.
You know, it's interesting to see this common theme definitely is a thread throughout your portfolio, not just in the home builders, but you mentioned in Target.
Let me keep going. I'm on a roll. The credit card spend on American Express is 4 times that of Visa and MasterCard. 40% of millennials say American Express is their number one card. What's the biggest difference between a 30-year-old that's got an American Express card that makes $80,000 or $100,000 a year and a Visa or MasterCard? What's the credit limit on the American Express? Way higher. So a guy gets married at 30 or 31 to a 28 or 29-year-old woman. That's pretty standard in the United States right now. And they get married and they buy a house. And the guy thinks, hey, I've done what this woman wants. And she takes one look at him and says, honey, we just did the first half of this project. Now we need mattresses, couches, lawn furniture, a fence, landscaping, yada, yada. You see, because a guy that's been single till he's 30 or 31, he's been a minimalist, right? He's either been living with his friends in a house, and they might have had one piece of furniture and boxes of mac and cheese and cereal in the cupboard with milk in the fridge and butter, because you need that to make the Kraft mac and cheese. So they've been minimalists. They don't even know what life is about. And they're going to get civilized by this woman. So here we go. Half of American Express is identical to Visa and MasterCard. And what do they trade at? 25 times, or let's just say 26 times earnings. That's probably low right now, but let's call it 26. So half of American Express is a credit card processor, and their take is higher on credit card processing than it is at Visa and MasterCard. The other half of American Express is a bank. And so let's say they're similar to J.P. Morgan. And let's say J.P. Morgan closed today after getting bashed in the head at, say, 11 times earnings. So if half of your company is a 26 multiple, that's 13 multiple points. The other half of the company is 5.5. That means that par on American Express is 18.5 times earnings in a market that trades at 17. Oh, but wait, it trades at 13 or 14. And Buffett brags about it in his letter, and he bragged about it at the annual meeting. These guys could own the world in 10 years. And they've got the highest credit worthiness people. 40% of people with incomes over $100,000 in the United States are American Express card holders. And the economy is likely to be better than people think. And the Federal Reserve Board guy, when what we're talking about kicks into gear the next 3 or 4 years, they're going to be pointing fingers at him like they did with Greenspan on the tech bubble and say, why didn't you get in front of this thing? See, they started getting in front of it this last year, and then they lost their courage because they got spooked about the economy. And maybe for good reason. I don't know. But let's just say, if you look at our portfolio, up and down our portfolio, the only thing that we've got that doesn't really play right into the 30 to 45-year-old demographic is we're in healthcare through Amgen, Merck, Pfizer, Johnson & Johnson, and Walgreens. And that's because the second largest population group is the Bill Smeads. And that's the baby boomers. And we want to be kept alive and in good health for a good 20 or 40 years. And regardless of what the politicians say, that's going to be a great business. By the way, one comment, I already mentioned Amgen. Merck and Pfizer, Amgen, all these companies expense the most important long-term capital investment they make. They are the opposite of the tech companies. The tech companies don't count equity compensation as an expense. In the case of the pharmaceutical and biotech companies, they expense their biggest long-term investment up front in the income statement. They have the most conservative income statements of any companies in the entire market. One of the reasons they've always traded a PE above the market, because they're clearly superior companies with clearly better economics. And they do great things for people, and they need to hire a better PR firm. They make medicine and treatment. They don't make drugs. That's something that Mrs. Reagan railed about. Just say no to drugs. You don't want to have people say you make drugs. They need to get a new PR firm. They make medicine. And by the way, is there a better reason for being the richest nation on the planet besides extending life? The only meaningful way to do damage to what we spend on healthcare is to shorten people's life through euthanasia, which, of course, I don't believe in for a minute, and I don't think most everybody else does. You spend 80% of what's spent on you in your lifetime on healthcare in the last 5 years of your life. So this idea that you're going to cut drug costs, medicine costs, which is 12% of healthcare spending, and do any significant damage to the cost of healthcare is typical hyperbole. And this idea that Buffett and Bezos and Jamie Dimon are going to get together and figure out through technology some magic wand, the problem isn't how to deal with people 30 to 50, right? That isn't the problem. That isn't where the money is. Willie Sutton robbed banks. Why? Because that's where the money is. The money is in the last 5 years of life at the hospital.
I love it. Well, Bill, that is a great overview of a very thoughtful approach and portfolio. You have me a little melancholy that I'm a quant because listening to your ideas makes me want to go out and buy all these tomorrow. As we wind down, we've already kept you for long enough. Our favorite question to ask the guests is always looking back over your career at all sorts of places, Smead and Drexel. What's been your most memorable investment? It could be something wonderful, it could be something terrible. Anything come to mind?
The biggest mistake was, since I just mentioned healthcare, I bought a bunch of Humana at $7 back in '99, and it went down to $5, and I stopped myself out, and it's now $2.50, 20 years, $7 to $2.50. Buffett says all his biggest mistakes were sins of omission. You know, I think the funnest thing was having my own clientele scratch their head in 07 and 08 as we loaded up on Starbucks because no one was going to want to buy a cup of coffee in the deepest recession since the Depression. That was the funnest one. That was our best performing stock, 9, 10, 11, and 12.
It's fun to look back on those.
Yeah, you wouldn't be talking to us if we hadn't done that.
You mentioned Buffett, and it's funny about the sins of omission because another one of your portfolio holdings, Disney, was one that Buffett often laments a little bit. Bill, this has been a blast. Where can people find you if they want to learn more about you and your firm and what you're up to?
Smeadcap.com. And all they have to do is add their email address and just a tiny bit of information, and we write about 40 times a year, and they can read our best thinking when they have the time.
Bill, thank you so much for joining us today.
Thank you.
Hey, podcast listeners, welcome. It's full on summertime. We have today an awesome show for you. We got a Dookie here, professor of finance at Fuqua, right down the road from me. He's trying to escape the humidity, flew west to in-office Los Angeles. Professor Cam Harvey, welcome to the show.
Great to be on the show.
Cam, I used to have this fantasy, and I'm sure most people do, about being a teacher and a professor where you just spend the summer on the beach, sipping a pina colada. You're out here hustling, writing papers. I mean, I stopped counting at over 100 at this point. How's the summer going?
Yeah, the summer actually is the time, interestingly enough, people think that you're on the beach, but no, this is the time to do your research. And that's the main thing you get paid for is research.
I always say that about taking a summer sabbatical and getting writing done. And it seems to never happen. I now have a 2-year-old, so he's kind of becoming the problem, I think. But writing for me, I don't know. I feel like summer's the hardest. But we're here in Los Angeles at the beach, so I don't know. Well, welcome. It's great to have you. We got to start out. You might be sick of talking about this point. I don't know. But we got to go way back. 30 years ago, your dissertation. It's super timely right now for the first time in maybe a decade. Let's talk about the yield curve. What's going on? You want to give us a little heads up?
Yeah, it is amazing that my dissertation still lives. Usually these dissertations are collecting dust on some bookshelf somewhere, but I get hundreds of emails about what's happening with the yield curve. And my dissertation in 1986 at the University of Chicago essentially provided a theory and some evidence that the yield curve, which is the difference between a long-term interest rate and a short-term interest rate, that was highly correlated with the business cycle and actually was predictive of what was going to happen in terms of real GDP growth. So that was what I published in 1986, so a long time ago. And it was actually pretty controversial dissertation at the time because I didn't have that much data. So I'm working with a data set from 1960s to mid 1980s, and I show that when the yield curve inverts, which means this weird situation where the long-term interest rate is lower than the short-term rate, when it inverts, it precedes a recession. The problem was that there was only 3 recessions in my data set. And my advisor is sitting there saying, well, maybe this is just a lucky finding. Maybe it's just by chance that you see this. Maybe it's not real.
Which one of the advisors was it?
One of the 3 Nobel laureates on my committee, Gene Fama. So they were skeptical, and for good reason, because that's not that much. 3 out of 3 within sample. It could be data mining. And you know how it goes. You publish your paper, and then the real world happens. We get the out of sample. And if you're lucky, usually, the effect gets weaker. And if you're in bad luck, the effect completely goes away. You've just data mined some finding. So what happened with me was different. We've had 4 recessions since the publication of my dissertation, and the yield curve inverted before every single one. Now, you might say, it's no big deal. You could have an indicator that says recession every quarter, and it's going to hit 4 out of 4 because it's constantly forecasting a recession. But it's interesting that there's been only 4 inversions, each preceding recession. So what's extraordinary is the 7 episodes that we've had, this particular indicator has not yet, and I would like to emphasize the word yet, had a false signal.
I would almost want it to have one, just say, okay, it's not perfect. So it's not 1,000%, but it's summer 2019 and it's tripped, right?
Yeah. So I've been watching this pretty carefully. In my dissertation, I looked at 2 yield spreads. One was the 5-year yield minus the 3-month Treasury bill. The other was the 10-year minus the 3-month Treasury bill. And notice that I'm using the 3-month Treasury bill as the short-term yield. Some people use a longer-term rate, and I do think that that's data mining. You might get a slightly better fit using a different piece of the yield curve, but I'm just not impressed with that. So what if you get a better fit with the 11-year yield minus the 7.5-year yield? There's a million different combinations here. Want to go with the spread that was published in my dissertation. It's got a long out-of-sample track record, and there's no indication that it's broken. But as you say, it is fired right now. So I'd look for a full quarter on average for an inversion. And June 30th, that was the full quarter. And both the 5-year spread and the 10-year spread were on average negative for the quarter. The quarter is the measurement point because GDP is measured quarterly. So it kind of makes sense. So the inversion is fairly mild, but it did trigger a forecast. And I would like to clarify one thing that's important. My model links the slope of the yield curve to future real economic growth. So empirically, we've seen that it predicts each recession. But the actual model links the slope of the curve to growth. So it doesn't matter if the curve is inverted or flat or slightly upward sloping. All of that means lower growth. So if it's the case that we go into a recession in 2020 or 2021, okay, well, that'll be 8 for 8. But if it's the case that we have a substantially slower growth in 2020 or 2021, let's say 1%, then the model's worked. The original model is about growth, and 1% or 0.5%, that's way below what we're used to in the high 2s or 3 range.
And explain why you think the economic theory works. Why is this something that you mentioned is not just data mined, but is actually, it would make sense that this is the way the world should be?
Yeah, there's many different ways to explain the basic theory. And one of them that I like the best is this model reflects what people believe in the market. So it's not like a causal model. So the yield curve doesn't necessarily cause a recession, with one caveat that we can talk about maybe a little bit later. It reflects what people think. So when people get nervous, they're worried about what will happen in terms of the economy, often there's a flight to quality. And the safest asset in the world right now is the US 10-year Treasury bond. And people start buying that bond, the yield goes down, and that is the action that you need to cause a yield curve inversion.
I mean, I think not too long ago, a lot of people were talking about yields at the 10-year going up to 4.56, and we're now back down to, I think, 1.7 or something around there. So for the listeners, maybe saying, okay, yield curve, forecasting recessions, how might this play out in sort of real-world application of asset management and returns? And you guys have done some additional work, partner with our good friends at Research Affiliates and others, that it turns out looking at the returns of the stock market before and after an inversion is actually pretty instructive too.
Yeah, so I guess the issue is, what does this mean? So, and I think there's two broad ways to look at this. So the first thing has to do with this idea of potential causality. And let me elaborate on this before we actually deal with how do you adjust your portfolio. So originally when I wrote my dissertation, nobody noticed. And people noticed a little bit in October 1987. And that was the crash of the stock market. And the consensus forecast for economic growth in 1988 was negative. So people just assumed there would be a recession and it was going to be a bad one. And at that time, I went on the record and forecast 4% real GDP growth in 1988. And that's essentially what happened. So a few people noticed. Then we had these two recessions, 1990-91 was pretty mild. And then the 2001 recession was such a minor blip that we didn't even have a year-over-year negative real GDP growth rate. But it was the global financial crisis, the yield curve inverting well before the global financial crisis, that
it was like 06, right?
Yeah.
Okay.
And people really noticed that. So, okay, this model's hot. So now I get remarkable publicity about the model, and you wonder if there's the possibility of a self-fulfilling prophecy. So people talking about it, oh, yield curve's inverted, we're going into recession, so I'm not going to pull the trigger on capital investment, I'm not going to pull the trigger on new hiring, people cut back on their spending, and that actually puts us into a recession. So the way that I actually look at this is the following. It's basic risk management. So given you've got an indicator that is a reliable indicator without false signals, should you ignore it? I don't think so. So should you borrow a lot of money to build that new plant? Well, why not wait to see how this plays out? And yes, it is possible that this leads to slower growth. However, as a company, there's two ways to deal with this slower growth. One, you borrow the money to make that big capital investment. We go into recession and you're out of business and everybody's laid off. Or you're cautious, you don't go ahead with that investment, and you survive. So it's basic risk management. Consumers, the same thing. This is not the time to borrow on your credit card to go on vacation to some exotic spot. No, this is a time to eliminate your credit card debt and to save. So there is this aspect that there could be some self-fulfilling prophecy that's linked to this. And the reason that I'm previewing this idea is very much related to what you asked me about, okay, well, what do you do with your portfolio? So it's not just a matter of capital investment or hiring with a corporation, or a retail investor basically getting their house in order. What about your actual portfolio? What do we do? This is a signal about the future growth in the economy. We know that stock returns are linked to growth in the economy. Think about the value of the stock is the expected cash flows in the future. And then we discount those cash flows by whatever appropriate risk. So the expected cash flows are impacted by the growth in the economy. And obviously, the risk is also impacted. Risk goes up if you go into a recession. So those two forces push down valuations. So what I did was the following exercise, and it's in a LinkedIn article that I just put up, and maybe we could link to it.
Yeah, we'll put it in the show notes.
Yeah.
All the stuff we talk about today, we'll throw in the show notes.
Yeah. So this is the idea. It's a really simple idea. And look, there's not that many of these recessions and yield curve inversions, but it's a very simple idea. Let's look at what happens if you invest in the market after an inversion. So I do the quarterly inversion. So in the most recent episode, it would be you invest after June the 30th, 2019. So even though the yield curve was inverted before June 30th, I wait for the full quarter, just in consistency with my model. So I do that and then hold the investment for 3 years. And then I also look to see what happened in the 3 years previous. So then I do that for every single yield curve inversion. We sometimes call this in finance as an event study. So time zero is the point where you've observed the yield curve inversion, and then you take a position. And we look at what happens 3 years after and 3 years before. So not surprisingly, if you look at what happens before, the market's doing very well before the yield curve inversion. And then if you look at what happens after, the market does poorly. So this is on average, and it's also the case that every inversion is different. So obviously, what happened during the global financial crisis is way different than, let's say, 2001 or 1990 and 1991. But on average, it suggests that this is a time of considerable risk of a drawdown in just a plain old long-only investment.
And if I remember correctly from the article, there was two pieces that stood out. One is that, I mean, the real return over the next year, this might have been net of treasuries, but was something like minus 9%. And there was an additional piece you went to the end where you also looked at the effect of value, where value is an additional tailwind, which is an interesting point of view because almost any way you measure it, value has been fairly terrible this cycle for the past 10 years. So who knows, it could be the signal to say that value may reclaim some of its former glory.
Yeah, so it's interesting to actually think about that. And we've seen that play out. You're exactly right. Over the last 10 years, value has done poorly. Do we believe that that factor will always do poorly? I don't think so. It's got a very long history. And it's also got a very long history of having like a bad run. So think about the 1990s, where value was underperforming year after year after year. And then in the late 90s, people eventually said, I had enough. I'm going to bail out exactly at the wrong time. So you're correct. I did the same study where instead of looking at the fully funded market return, so the market return minus the borrowing cost, I looked at the value factor and how it actually performed in the same sort of analysis. And it was striking. So it's the complete opposite pattern. So before the inversion, value's doing poorly. And it's kind of consistent with what we've lived through for the last 10 years. And then after the inversion, it does well. So the way I look at this is that it's very important to have a sense of timing. So it's one thing to be exposed to factors, but it's another thing to move your exposure in a way that's consistent with some notion of timing. So there's certain times in the business cycle where it's great just to be long only in the market or in growth. There's other times that it's great to be in value or some other factors. So this yield curve indicator is a piece of the puzzle, I think. It's a very reliable way to forecast economic growth. And we know that all of these factors are impacted by economic growth. So why not use that information? And it's not just value, but there are other factors. I've got another LinkedIn article I've not posted yet, but I will preview that I've done the same exercise for other factors. And again, there's a variety of different performances across the individual recessions, but this is the time to have some of your portfolio tilted towards things that will do well when the market goes down.
And I would think as an extension, that would probably, if I was a betting man, guess that applies to probably the safer sectors, maybe like consumer staples, and also potentially some other asset classes. I would guess that maybe gold or commodities would do well during an inversion. I'm not sure. I feel like I'm recalling some research there somewhere. I don't know.
Yeah, so you're correct that anything that's quality does well after an inversion on average. And again, I'm talking inversion and just assuming that it's associated with the recession because that's what's happened historically. I've not looked at the commodities, but I do know from my research on gold that gold's just all over the place. It's not a reliable hedge. So it's only a reliable hedge over extreme long term.
We had Claude on the podcast a while back, so we spent a lot of time talking about gold and some other ideas. So it's interesting. I mean, I think there's a lot of areas for research on the yield curve ideas, most of which the thing I like about it is that it has grounding in theory and it somewhat makes sense. Why don't we start to transition a little bit away from the curve? Oh, actually, there's one more thing I want to talk about on this before we transition. You mentioned a fair amount of ideas and concepts around it being people's emotions and beliefs and whether it becomes a self-sustaining prophecy. One of the things that you started at Duke was starting to survey, is it CEOs or CFOs? I can't remember.
Mainly CFOs, but some CEOs.
Why don't you talk to us a little bit about that and what they're all saying today as a potential bridge of kind of what we were just talking about too?
Yeah, so if your listeners don't know the survey, they should. It's called the Duke Cfo Survey, and it's been going on for 25 years. And it's somewhat under the radar because we don't have like a PR agency promoting it, but it is a survey of CFOs, and the CFOs are the ideal people to ask about things like future economic growth. The survey of economists that are done, those are the wrong people to ask. They don't know what hiring plans are over the next year. They don't know what the CapEx plans are over the next year. Indeed, they might know a very limited amount outside of their institution. So these CFOs are on the ground. They, again, know the plans before the plans are actually executed, and they give us advanced knowledge of what's happening. And again, an interesting validation of our survey, go take a look at the Fed minutes that are online and search for Duke. And you can see how often the Fed actually talks about our survey. So this survey, again, has got a long history. We usually have about 400 US CFOs, but it's a worldwide survey. So we've got well over 1,000 CFOs around the world that provide information for us. And we ask them about their hiring plans. We ask them about their employment, their payout plans, all this stuff. But we also ask them about a recession. And the responses recently have been striking. So you've got 85% of these CFOs believe that a recession will begin in 2020 or the beginning of 2021. And that's consistent with the message from the yield curve, because the yield curve, it inverts. It doesn't mean a recession starts immediately. There's a lead time. And the lead time could be 9 months. It could be 18 months. It's not consistent in terms of the lead. So the CFOs are essentially saying the same thing, that they believe that there is great risk that we will go into a recession or at least slower growth.
What's the normal sort of response? Is it like half of them would say it's in the next couple of years, or 20%, or is it all over the place?
It's not all over the place. Usually they're quite optimistic. And we've got all sorts of things that we track in terms of their optimism. And it isn't all over the place. So again, we got 400 of them. If it was one or two, it would be all over the place. But 400 of these CFOs, and we measured this fairly carefully, and it is very predictive. So we've done the analysis. We've got enough data. So early in the survey, we couldn't do this, but we had 25 years of data. So does the CFO survey predict CapEx spending growth? Yes, it does. So does the CFO survey predict the consumer confidence index? Yeah, it does. So again, that index, let's say the consumer confidence index or index of leading indicators, those are all supposed to be leading indices. So we actually predict those leading index.
They tend to be helpful on the flip side too, when times are dire. So like thinking back to the financial crisis, are they pretty good at starting to see on the horizon that times might be getting better, or they just become super dour and depressed as well then?
So let me talk about the yield curve on that as well as the CFO survey. So the yield curve is really good at predicting recessions. It's good at predicting the duration of the recession. So for example, the yield curve was inverted in the global financial crisis for exactly the same amount of quarters as the length of the global financial crisis. So I got the timing of the crisis, I got the duration. What the model isn't that good at is the severity of the crisis. Indeed, it was comical to me that somebody wrote an article that was highly critical of my yield curve forecasting and pointed out something I wrote in 2006, predicting the global financial crisis, predicting the duration of the crisis. But what I didn't predict was the severity of the crisis. So I did a poor job. I only got 2 out of 3. 2 out of 3 with a single variable. This isn't like 1,000 equations and stuff like that. It's a single variable. So the duration you can get from this particular model. But I would also say that turning points are obviously very difficult to forecast. And the yield curve appears to be a fairly good predictor of both types of turning points. So one turning point is where you go into a recession, and the other is where you actually get out of the recession. But, and this is very important, the turning point where you go into a recession is way easier to get wrong. So it's very difficult to call that particular turning point. Whereas the turning point where you leave a recession, that's fairly easy to do because recessions are short. So the recession might be 3 quarters. It might be 4 quarters. It might be a little longer. So in the recessionary period, you can be wrong by a little bit getting back in, but you're not going to be wrong by that much. Whereas forecasting the turning point down, you could be out of the market 5 years too early, or you dump your value stocks exactly at the wrong time. So there's an asymmetry that's really important here. And I guess it's a long way of saying that the turning point where things recovered, that's a lot easier to forecast. Indeed, you don't even need a model for that. We just know that these drawdowns are not long in duration.
Yeah. While we're on the topic of interest rates, I had a quick question before we move on in yield curves. a lot of talk in the media today about negative yielding bonds. As a professor with your ivory tower hat on, is this something in the development over the past 15 years that you've seen as a surprise? Is it something you see as a normal state of affairs? What's your general just kind of thoughts on the way the world looks today with, I think it's not just now sovereigns, but also even some corporates, et cetera?
Yes, so it is a different world that we live in, but we've seen negative yields before. And my time, the classic negative yield was investing in a Swiss bank account or a bond. So you would have to pay for that. And it kind of made sense because Switzerland was the safest place in the world, and you're willing to pay to keep your money there. So these negative yields are not historically unprecedented. What is historically unprecedented is that close to 60% of the sovereign bond yields in developed markets and some fringe developed markets have a negative yield, including, and it's striking, last week, the German 30-year bond went zero and slightly negative. So to explain this is complex, but the other thing that's important just in the background is that yield on the US 10-year, that's looking pretty good.
Believe me, we have a high yield sovereign bond fund. We had to change the name, excuse me. It's something like that, but it's basically a carry fund, and it's a bunch of emerging markets, and then the U.S. is one of the highest yielders, or was, I said, before this massive rally. I don't know if it'd still make it in there, but it's funny to see.
Think about it. So the German 10-year, negative 0.5% approximately. And again, that has to do with quality. So people believe that with all the stress that the EU is going under, that if they're going to make a bet, it's going to be in Germany, the strongest economy amongst all of them. So part of it is a flight to quality. The other thing that can't be ignored is the interventions of these central banks, which has been extraordinary in trying to kind of micromanage what's happening in the economy. And I think that the sort of distortions that have been induced, we're going to pay the price for later. Indeed, as you said, the people, oh, well, I'm not getting any yield on my government bond, so I will increase the risk. And that's fine for certain people. And I'm certainly an advocate of investing in a diversified portfolio with emerging market bonds and things like that. They should definitely be in that diversified portfolio. That's not what I'm talking about. I'm talking about the person that's socked some money away for their pension, and they dramatically retilt their portfolio towards high yield EM debt. And then when the episode happens, they're walloped with a massive drawdown that they didn't expect. So they are essentially mismatching the risk that they should take. And it's induced to a large degree by this distortionary policy.
Speaking of policy, again, we're taking another left turn. I mean, one of the struggles we have a lot here is thinking about how to align long-term investing success for the vast majority of people in this country, incentivize people to be investors, incentivize people to participate in the growth of not just domestic, but world economies. When we really transition from a world of defined benefit to you're kind of on your own in many cases.
A terrible mistake in my opinion.
Yeah, and so as you talk to your students, as you talk to whether it's policymakers or everything else, I mean, we spend a lot of time trying to think of, when we manage public funds and we see people behave poorly over and over and over again in our funds. And I said, I'm trying to think of behavioral ways to say, is there a way we can lock people, and not from a selfish point of view, but is there a way to get people to behave better? And so in some cases, it was like almost like the concept of an annuity or target date fund, but without the massive fees. I mean, I think the fee on an average annuity is like 2.25. So it like destroys all the benefits of it. Do you have any general thoughts before, I'm sure you do, any thoughts on sort of this, if you were giving advice to Congress or the president or anyone else, any general thoughts?
There's a lot of research on this in finance and these defined contribution plans have been a disaster. And it kind of makes sense, right? That people aren't necessarily experts in portfolio management. They're working their job. They don't have the time to invest into learning about portfolio theory. I'm sure they could do it, but they don't have the time. So you give them this option, you do the 401k, and it's usually a disaster in terms of the outcome. The research in finance has looked at other countries and what they do. And one model, there is a diversified portfolio that is the default. And if people strongly believe that that is not the portfolio they should invest in, fine. They had the option. And if they lose their money, it's their fault. So I do think that we need to help the general public on this, and it makes sense to do something like that. But overall, it has not been a good experience. And I'm afraid that everybody's going to pay the price because these portfolios in the future will not deliver what was expected at the time of retirement, and we'll have to pay directly or indirectly. So the cost is very heavy.
And we don't even have time to get into all the pension funds that still expect 8% returns every year to infinity. But yeah, it's something we struggle with, think a lot about. Listeners, if you get any good solutions, send them my way.
It's also the case that there are certain assets that if you're young, you should be investing in that have the high expected returns. Indeed, ideally, you're borrowing at that age and investing in high expected returns.
Well, the young people get the first part of that right. They get the borrowing, not necessarily the investing.
Exactly. Borrow to spend rather borrow to invest. And it's kind of also interesting to me that a lot of the flexibility to invest in growth companies has been removed, given that just the number of stocks has gone down dramatically. So I do believe that that will change, that in the future we'll have the ability, just the average investor, to take a piece of like a venture fund or something like that. And there will be like new assets that will emerge in the next 5 years, which will help because you really need to get some of your portfolio into that really high expected return tranche. And right now it's just not available to the average investor. It's not even available to some of the larger investors, but it's definitely available to the institutional investor and the very rich that are the first in line to get a piece of Facebook before it went public.
You know, the accreditation rules are somewhat odd, and I sort of oscillate on my belief here, and there's talk of removing them. It's almost like I would prefer, instead of it just being you qualify because you're rich, it's like you almost have to take like a DMV test. Like you take this test, fine, you can go throw all your money down a hole. But given the fact that the state of sort of personal finance education in this country, of people investing so much in lotteries versus investing in their retirement, versus it's almost, because we don't teach personal finance in high school or even in many colleges, the ability to say, look, let's not make it an accreditation requirement, just to not benefit the rich, but let's make it almost like, here, take a test. And if you pass, you can light your money on fire if you choose to. You're starting to see a lot of the blurring of private and public markets, I think, where a lot of what used to be more IPOs are staying private longer, but those seem to be opening a little bit to becoming a little more liquid. Who knows?
Yeah, no, we'll see a lot of liquidity. In terms of what will happen in the future is that we've got this ancient system that's lasted for over 100 years where to buy a stock today and get official custody of the stock takes 2 days. That's ridiculous. So it shouldn't be a settlement time of 2 days. And the number of middle people is enormous. Everything will be tokenized, and these tokens will be available to all investors. And you're right, some investors might abuse that, but if it's within a bucket of 10 to 20% where you can invest in your favorite startups, and yes, that is kind of like a lottery, but it's over a long period. So you're young, you've got 40, 50 years to write out a lot of these investments going to zero. So I do think that it's important. I think it's important for the economy also. We need investment in innovation. And right now, it's really hard to do. Many of the entrepreneurs, their first source of financing is borrowing on their credit card. So that is looking enormously expensive, a 22, 24% interest rate. And you think about, they're looking at a project that looks pretty good. They can make 15% a year, but they don't do it because the credit card is going to cost them 24% a year. So they let it go. So all these projects that are really exciting projects are not pursued because the financing is just not available right now. In the future, it won't be the same. You won't have to IPO. You won't have to go to your bank and go through all the hoops at the bank. It'll be more peer-to-peer. It will allow for more innovation. And I see that not in the long term. I see that in the next 5 years.
And two quick comments here. One, what was sort of the origins on you becoming interested in sort of the blockchain smart contract space? Was it student driven? Was it just reading the academic literature? And second, this is a two-part question, totally unrelated. Would love to hear your thoughts, if any, on if you love, hate the idea of income sharing agreements, where a lot of these colleges are starting to do it for, instead of students taking on a bunch of debt, where they'll essentially be able to give back a little bit of their income. There's some companies like Lambda Schools doing it, as well as other companies outside of the education system doing it. So anyway, that's complicated two questions.
So the origins of me being interested in blockchain, and that's what I teach at Duke University. It's a course called Innovation in Crypto Ventures. 6 years ago, I retired as editor of the Journal of Finance. I hadn't taught in 6 years, and I decided to revamp my investment course. And it was an international investment course. There was a section on FX. And I figured, well, I'm doing the euro, the dollar, the yen, ... What about this thing called Bitcoin? And I heard a little bit about it. So I decided to add a section on cryptocurrency. And at the time, that was the only blockchain application. And I started to prepare this 2-hour lecture and immediately realized that this was way more sophisticated than I thought. So I heard a lot of misinformation. I started reading the background and about the structure of the basic idea. I read about all of the failures of digital currencies in the past. We've been researching digital currencies since 1981, and every single one failed. And they failed for a very simple reason, that if you think of a photograph or a music file, a video file, you can make a perfect digital copy. So for currency, you can make a perfect digital copy. So you need some sort of ledger that keeps track of the serial number. Think of it that way. And that's what this technology actually does. It makes it possible to have a digital currency. So very exciting. I did that 2-hour lecture. My students, I thought I bombed in the lecture because they just sat there. Usually they're out of there as soon as we hit the hour, but they're just kind of sitting there. And then they came up to me and said, that should be a course, not a lecture. And I reshaped it into a course. And the course is a blockchain course. So I talk about cryptocurrency, but it's not a huge part of the course. It's on the other applications. So contracting, eliminating much of the back office, supply chain applications. There's hundreds of applications of this technology that are emerging, that are really exciting, that I think you really have to be in this space. So that's the origin of my teaching. And now it's 100% blockchain teaching.
That's awesome. Is enrollment in 2019 like versus 2018?
Yeah, so very interesting. Yeah, the enrollment was highly upon the price of the cryptocurrency. So in 2018, I had 231 students, half of the class at the Fuqua School of Business at Duke. However, unfortunately, many of those students were there for me to teach them how to become a cryptocurrency millionaire or billionaire, right? They want that Lambo. So my course is not just a cryptocurrency course. Again, it's a blockchain course and it's very broad. It brings students not just from finance, but from strategy, from marketing, from accounting. And it's very diversified in terms of the application, both for-profit applications, non-profit applications, and it grows every year. But let me get to your second question.
Which, by the way, again, totally unrelated. It was in my brain, so I had to spit it out before I forgot.
Yeah, so we actually do in my course. In my course, the grade is determined by a 15-page pitch deck for a company that is using blockchain technology. So a number of groups have presented ideas that are related to having a register for a particular asset. So it might be a painting, a very valuable painting that there's no way that the investor could actually own that. But if you tokenize the painting, then you got to have many people actually owning it. There are many other applications that we look at, but one of the applications that constantly comes up is human capital. So human capital is the most important asset in investors' portfolios, yet we often completely ignore it. And we ignore it because the data is hard to come by. For example, we think of having a diversified portfolio. And let's say that you work in the mining sector, to give an example. And I give that example because it's a very pro-cyclical sector. Your portfolio shouldn't have any mining stocks because you're already invested in mining. So, and this holds for individuals, it holds for large institutional investors. The giant $1 trillion Norway pension plan, it basically is funded by oil and gas revenue, and they shouldn't be invested in oil and gas. So this idea that you need to look at your portfolio as a whole, an important aspect of your portfolio is your human capital. And that needs to be taken into account when you actually design your portfolio. It almost never is.
So you're saying you shouldn't put all your money in your company's stock in your retirement plan?
Okay, so that indeed, you could argue that you should short, but we really can't do that because it would create a perverse incentive. So yes, you need to have one of the most basic things in finance is diversification. And this is diversification. But what I'm saying is that you need to look at all of your assets. So when we talk about the market portfolio, people think of that as, oh, well, that's the equity portfolio. No, it's not just equity. It's credit. It's real assets like real estate. It's human capital. It's just really hard to measure that human capital. So there have been some experiments in the past, and the most famous experiment of monetizing human capital is the so-called bond. So it's David Bowie. He issued a bond that was collateralized with royalty payments from his library. And that bond, I forget the exact maturity, but it sold well. And he was essentially able to get the money up front from the future royalties. And the bond matured and everything went fine. So for David Bowie to do this as already like an established performer, that's one thing. But it's another thing for somebody just starting their career to say, I'm going to sign off 10% of my income to pay for my college. When that 10% of the income, if they do really well, could be millions of dollars. So we need to be like really careful in actually designing this. But I do believe, and again, it's linked to my course because we've got many more applications. Again, these applications are usually people like performers, whether it's entertainment or sports, that have the ability to monetize their human capital. So we don't do a good job of this in two aspects. The first aspect is people ignore this for their portfolio and make a fundamental mistake. And the second is that we don't have a very good mechanism to monetize the future value of that human capital, but we will. And that's where this tokenization comes in. It provides a way to do this at a fairly low cost.
Yeah, one of the papers we had written was kind of along these same lines of specifically to the asset management industry, making the argument that most financial advisors are like 4 times leveraged the stock market. Said they own stocks in their own portfolio, which is most of their investments because stocks are more volatile than bonds. Their clients are all invested in stocks, so the company's revenue stream is exposed to that. Often clients will panic when times are really bad, and so withdrawal during a recession or depression shouldn't be if the financial advisor is worth his salt. And then lastly, if you work for a company that's not your own company, like a wirehouse, like Morgan Stanley or Lehman, you're exposed to that company being exposed to the revenues. And so I said, theoretically, like a airline would hedge fuel or a cereal company would hedge wheat, theoretically, financial advisor, you can make the argument that they shouldn't own any or even be short. And I don't think it's our least read paper and no one has any interest, but it's something we've thought about here quite a bit.
It's so basic. That's the thing, that it's remarkable to me that the idea that you need to be fully diversified and look at all of your assets, that's a basic idea. Yet it's like totally orthogonal what happens in the market.
I think that if you applied it to like housing, people can kind of get it. Like if you're a real estate guy, you shouldn't necessarily be buying 100 houses. It's a little more tangible than I think the investment market, but whatever. It's we'll post at the show links. I don't think anyone will read. We heard a couple of funds that reached out and said they've implemented some ideas there, but
it's a basic mistake. That's the thing. And what is remarkable to me that there are so many basic mistakes that are made by investors. And again, I'm not just talking about a small investor. I'm talking about large investors thinking about things just really incorrectly.
What's your favorite? This will be a good transition to the 3 blunders, but do you have a favorite mistake? That I've got a long list, but chasing performance is probably number 1 for me. That's up there.
That's really up there. But how about this one? I get a phone call from a former Duke student saying that they've got this fund. It's a really simple idea. They've outperformed 10 years in a row and wondered if I wanted to become an advisor. They've raised a huge amount of money. So I said, well, what's your strategy? I said, well, what we do is we just roll the S&P 500 futures, and it gets us beta of 1. And then we write some put options and collect the premia. So we collect about 200 basis points of premia every year, and we outperform the market by 200 basis points. And I said to this former Duke student, I said, you're a former Duke student, but I actually don't remember that you were in my course. And he said, oh, you're right. I didn't have time to take your course. So you would have failed my course because that isn't outperformance. That's taking risk. And yes, you make a premium over the benchmark of the market, but that's not the right benchmark. You've got this tail risk in writing that option. If the market goes down severely, you're going to take a massive loss. So you are not looking at this properly in terms of risk adjustment. You are not outperforming. You are basically just getting paid for taking the risk that is involved with writing the option. So things like that are just routine. We see this all the time, that option writing gets mixed in just before the end of the quarter so it doesn't show up on the filing. So people basically taking this downside risk that isn't that visible until it happens.
And the option selling is like, it pops its head up like every 3 to 5 years. You see a fund going around marketing itself with a Sharpe ratio of 2 or 3 that just writes a bunch of options. And then the markets change, sometimes nat gas, sometimes S&P. And every like 3 to 5 years, we write an article about it. But it's funny, the nice thing about having a blog is you can go back and it's like a diary from over 10 years ago now at this point. And all the option sellers, we had a huge chart. And this is just waiting to blow up. And you fast forward, none of them exist anymore. And I think there's ways to do it, absolutely.
You can do it tactically. So I have no problem with that. So you look at particular options that might be underpriced and you buy them, or overpriced and you sell them, or you put on an option sell or buy at a particular point in time tactically. So there are plenty of ways to actually do this. But what I'm talking about are the people that just don't get it, that this is just taking risk. And when you take that risk, you get a reward. That is not alpha. The alpha in what I described is zero, and it's not outperformance. And it's striking that you see this so often. And look, people look at Sharpe ratios. That's another example where, as you mentioned, somebody's got the Sharpe ratio of 2, looks great. And then another strategy has got a Sharpe ratio of 0.5. Well, if you look at it more carefully, the Sharpe ratio looks at the expected excess return divided by the volatility. Volatility is a symmetric measure. What I care about is not just volatility, I care about the downside risk also. And it's no surprise, the style that's got the highest Sharpe ratio has also got the biggest downside exposure. And the one with the smallest Sharpe ratios got the biggest upside exposure. So given that people like the upside exposure, they don't like the downside exposure, that will skew the Sharpe ratios. So it's a basic thing that, again, it is so prevalent, not just small investors, but large institutional investors going down the sheet, looking at the Sharpe ratios and I like that strategy without thinking about what it does to the tail property of their portfolio.
Well, it's like the old Texas hedge. You buy the futures, short the puts, and buy a ticket to Argentina. In case it doesn't work out, you got a ticket to somewhere. That's funny. I could probably go talk about my pet peeves. A lot of it, particularly at this point in the cycle of the U.S. stock market romping and stomping and really just creaming everything else in the world. So much we spend time on this podcast talking about expectations, where we have people talking about expecting somehow 20% return, Sharpe ratios. You basically can't find the best performing hedge fund investment managers of all time. A Sharpe ratio of even above 1 is largely unsustainable over very long periods. It's just really hard to do. And as are 20% returns, of course. Let's talk a few more blunders, because you wrote a paper about it with our friends at Research Affiliates, Alice's Adventures in Factorland. You want to tell us what that's all about?
Yeah. So the idea of the paper, we look at 3 mistakes that investors make with respect to factor investing. And let me go through some of these mistakes. The first one is really basic. There are so many factors out there. There are thousands of ETFs offering factor exposure. In my own research, I've documented 500 factors that have been published in the academic literature and make the point that that understates the number that have been discovered, because many of them weren't published because they didn't work. And let's put work in quotations. So with all of these factors, it is obvious that some of them are just purely data mined. So investors need to be especially careful that you get somebody that is proposing a new factor, offering this great premium. It looks great in the back test, but out of sample, it will likely fail because so many things have actually been tried. And we see the same sort of phenomena within kind of a known factor. So somebody's got a better value factor. So how did they come up with the better value factor? They looked at 50 or 60 different combinations of things that represent value. They put a weighted average of certain things that work together, and it outperforms a plain vanilla value factor. Do I have confidence that it will outperform in the out of sample period, in the live trading period? No, it has been data mined. So the amount of data mining is enormous. There's organizations, they don't care. They will put out 300 different factor ETFs, fully knowing that a good chunk of them have nothing. So they're essentially false. But they hope that a number of them will look good. Those will be continued. The other ones dropped. And you know how it goes. So basically, the loser here is the investor. You need to go head on, realize that the data mining is severe. Some of these more recent factors that have emerged are probably false.
Do you have a favorite nonsensical one?
Oh, yeah, I got.
It's funny when you talk about this because you say, look, almost everyone is working from the same CRISP data set. Almost everyone has a lot of PhDs. And so if you go type in, even in some of the multi-factor funds, the ones that, if you're using value composite, it's legit, you'll see AQR, LSV, DE Shaw, all the owners, the same thing. So to find a factor that's really honestly unique, it means it has to be either probably you have an entirely data set that no one else has, which is pretty hard. Otherwise, everyone is trying to do it. Or you have a particular insight, which, let's be honest, is pretty hard and rare to find something that is also not going to be like just co-correlated to another factor. But were you talking about the letters of the alphabet? Was that your factor?
Let me tell that story.
Okay.
So this is my favorite factor that I introduced in my presidential address to the American Finance Association. So I showed this exercise that it used the so-called CRISP data, so all the equities in the U.S. from 1963. And I showed cumulative returns for a strategy that I said was a new factor. And I said, look, I was really careful in doing this because I split the data. So I used half the data to engineer this factor and then the other half to validate. And if you look at the cumulative returns, it's a straight line going up. There's a few blips, but every year looks really good. It's got a great Sharpe ratio. The global financial crisis, you can't even see it in the data. You can't eyeball it in this particular strategy return. And then on top of that, this strategy has no correlation with the market return. It's got no correlation with value, momentum, size. It's got zero beta across all of the well-known factors. So essentially, this is pure alpha. And people looking at it, and even at the end, often at the very end, you see a trailing off of performance. No, not this factor. So people very excited about this, that I've introduced something that will revolutionize perhaps finance. And then I told them what it actually was. And what I did is I looked at all of the stocks in the universe and basically formed portfolios based upon ticker symbols. So think of the A portfolio as all the stocks that have A as the first letter of the ticker. And I also did this with the second letter and the third letter. And this great portfolio was short the stocks that have S as the third letter of their ticker and go long the stocks that have U as the third letter of the ticker. It's great. It just knocks the ball out of the park. It is completely bogus. And this is exactly what's happening. This is just an example of data mining where there's no foundation whatsoever. And look, I used tickers, but there's another paper out there that looks at 2.1 million different combinations of things to try to see what works best in terms of a factor. And the numerator of this factor kind of makes sense. It has to do with earnings per share. But the denominator is rental payments that the firm owes 4 years out. So it's a fundamental variable. It's not like a ticker symbol. And it just does amazingly well. Again, it's useless. Nobody would put money on something like that. You can't tell an economic story. But we're faced with this problem that people are selling stuff. Often there's no economic foundation to the particular investment, or the foundation it comes after the fact. So they find something by data mining and then come up with a story. That's not the way research is done. You come up with a plausible economic story, and then you go to the data to see if it's supported in the data. No, people are basically data mining. They're torturing the data to try to find something that they can sell. They will wrap it with some story, and it's the investor that's the loser. They're almost surely disappointed.
What's not surprising about a lot of those funds is they tend to also be high fee, right? As they almost universally tend to be expensive. You don't see too many really low, although, this is changing a little bit in the ETF world today as there's some really low cost funds, but you tend not to see
a lot of the slick ideas come out as a 10 basis point fund. They tend to be 1.5%, 2% often.
And that pricing could be set because the people that have developed the idea are very skeptical of the idea. So you might as well get the money while you can. And the fees are set high initially. And it's kind of a false sort of portrayal of quality, because often you set fees high that support your story. Oh, well, this is really special. And yeah, we can set fees high because we can. And if you don't want in, fine. So there's a lot of game theory going on also, but I do think that the actual people running the fund are themselves skeptical. They've got a short sort of life and to the fund.
You led into my favorite stat, which is percentage of mutual fund managers that own $0 of their own fund. And in some categories, it's like 50 to 80%. It's the most and I used to joke. I said, I don't understand why this is. Then I said, actually, one day I woke up and said, oh, it's because they're smart. They know they shouldn't be investing in this terrible, tax inefficient, expensive vehicle that they themselves don't believe in. So I think that's usually a big red flag on a lot of funds there.
The second blunder that investors make is kind of related to what you're talking about. And that is that investors have a very naive view of risk management when it comes to these factors. So we often see the factors kind of described in terms of so-called normal bell-shaped distributions when these factors are highly non-normal. So the tail behavior in these factors is way more severe than what you would expect with a so-called normal distribution. And in the paper, we go through factor by factor, and we do this really interesting exercise that focuses on momentum. So what we do is, in kind of the early sample of the momentum factor, we look at the returns of the momentum. This is cross-sectional momentum factor. And then we match that with a normal distribution. So if the historical return is in the 5th percentile, then we also draw the 5th percentile of the normal. So we've got this fake portfolio as if momentum was normal. And it tracks fairly closely to momentum until momentum crashes. And then there's just a dramatic difference between the two. So the idea here is that many of these factors are subject to crash risk that's not taken into account. And people are surprised by this. And they should not be surprised by this. And so I think it's a big mistake that investors make. And kind of related to this mistake is this idea that they think that some of these problems can go away if you diversify across the factors. So it goes something like this. Well, we know some of these factors are probably fake and data mined, but we've got a factor portfolio and we've got enough good ones that we can write out the bad ones. So that's one logic, which I don't particularly like. Why would you invest in a fake factor? But the second one is, oh yeah, well, we know that these factors have some non-normalities, that we know that they've got tails. And that's exactly the reason that we're not invested in one factor. We're invested in a factor portfolio. So that turns out to be very naive also, because that kind of assumes that when you put many of these assets together, you get back to the so-called normal distribution. Indeed, there's a theorem in mathematics called the central limit theorem that actually predicts this. But it turns out that in the particular finance application, it's not a very good application of this theorem. So what happens, you put this portfolio together, maybe 5 or 10 factors, and it doesn't look normal either. It's got the same downside risk. So that, I think, is a naive view of diversification that's kind of related to the third blunder. And the third blunder is that people are just not very good at taking the correlation of these factors into account. So there's a reason that when you put a diversified portfolio of these non-normal factors together, you still have a crash risk. And that is that when one factor crashes, it's bad news for the other factors, that the correlation actually increases. So in a drawdown period, the correlation actually goes up and it works against you. So we've got this really powerful graph in the paper that looks at the beta of a factor portfolio against the market. And right before the global financial crisis, it's got a beta of about -1 or even below -1. So if you think you've got a long-only chunk in your portfolio, most of your portfolio is long-only market, and then you layer on factor exposure, you think you've got a beta of -1. The long-only part has got a beta of 1. You go into the financial crisis like, well, it's no big deal. Even if we have a correction, I'm essentially neutral out to the market. So the crisis unfolds, that beta goes from -1 to 0. So it dramatically changed. So you thought you had this hedge, the hedge vanishes. So this idea that correlations are somehow fixed and constant through time is something I've been preaching about for years. And it just is amazing to me that people don't take this into account. Initially, the first time that I talked about this was in the context of diversifying your portfolio in terms of international investment. So you look at the correlations, and let's say the correlation on average is 0.5 for international investment. You add it to your portfolio, you reduce the risk of your portfolio. That's great. But that correlation is an average correlation. So what happens when the US market goes down dramatically? So what happens is that 0.5 correlation turns into a 0.9. And the international markets go down also, so you don't get the diversification. And then when the market is going up, the US market's going up, you'd like to get that 0.5 also. So you get some carry along. But no, when the US market's going up, the correlation goes down. So on both sides, US market going up or going down, you're a loser in terms of what you expected in terms of the correlation. So this is a story I've told for like 20 years. And the same story applies to factor investing. So the correlation is not constant. And when you most need that diversification from the factor portfolio, it often vanishes. So what we argue in the paper is about kind of 3 blunders that investors make. The next paper that we're working on right now is how to mitigate some of these mistakes.
Not just the prescription, but now we're getting the solution.
The solution. And obviously, to preview some of it, one thing that's very important is correlation management. So correlations vary through time. I've got an old paper with Claude Herb, who you said was on recently. And what we did was we looked at historical correlations between asset classes over the longest possible period and related them to things that we can observe in the economy. And we actually found that these correlations are predictable, highly predictable. So you think about the stuff that is predictable in finance. Volatility is very persistent. Correlation is predictable. The returns are much more difficult, very difficult to predict returns. But what we're saying, even if you can't predict the returns, to have some sense of the timing of the correlation is very valuable. And people do this for volatility also. So people do volatility timing or risk parity or stuff like that. It's an easy way to get some extra return in certain asset classes like equity and credit. But this idea of actively managing correlations is very important. Indeed, the idea is a basic idea, and that is that every person that is an asset owner should be able to answer the following question. What happens in 2020 if the S&P has a drawdown of 45%? What is going to happen to your portfolio? If you don't have a pretty good answer to that, then you're not doing your job as an asset manager. Indeed, it's really easy to be an asset manager over the last 10 years when the market's just going up.
I have a solution for you. It's you have a private equity fund that only discloses the NAV once a year.
Yeah.
That's how you avoid the drawdown.
Oh, and
or you're an endowment, you only have to disclose it once a year.
That's on my list, where the people think, oh, well, I've diversified my portfolio with private equity because it has very low correlation and very low volatility. Well, it's just false. The volatility is no different than comparables in their portfolio, and people just get misled by that spin. It's awful mistake. But yeah, this is really important to do that correlation management. These correlations are predictable. The risk management of knowing what's going to happen in a drawdown are important, because as the drawdown unfolds, then you know how to readjust your portfolio. That you say, well, we planned for this, and this is what we're going to do. And you've got a strategy. The worst thing that you can do as an asset manager is to improvise at the worst possible time where there's chaos in the market. You need to have these different scenarios, understand your exposure, your factor exposures. So these three blunders, it doesn't mean that you shouldn't invest in factors. That's totally not the message of our paper. You need to be wise. You need to be a skilled manager of the actual factors. You need to take basic things into account, that volatility is persistent, and that is going to be an important driver of your weighting of factors. The correlation management needs to be very carefully taken into account. In doing that, you maximize the chance that your portfolio will outperform others in a time of stress. You can't completely crisis-proof anything unless you do something at very high cost, like buy put options, which is very, very expensive. But there's many things you can do with a factor portfolio that can manage a drawdown in a way that you end up as a winner rather than a loser.
Well, I think so many people in the industry, if you're a student of history, I think it helps a lot. One of our favorite books is Triumph of the Optimist. It looks back at a lot of the historical returns of markets throughout history. And the problem, I think, with 2008 for so many people is they always, I don't know if dependent hoped is probably the best word, that these correlations would help them. And 2008, 2009 was one where you hadn't seen a market like that in a while, where I think the 2000 real estate and commodities did fine. And so everyone started piling into other things like the BRICS and all sort of other ideas. And then 2008, 2009 happened. Of course, then what did everyone become interested in? Tactical or maybe CTAs after that. But then you've had this romping, stomping bull. But it's interesting that in some of the cases, the asset classes, the ones that people particularly expect to hedge some of the time. You mentioned gold, that works decently, but not always. I think one of the worst months in the S&P, gold was down like 16% or something. But puts, you say, is almost one near guaranteed, but that's the way markets work. You got to pay for it, right?
That's right. If you want insurance on your house, fire insurance, you got to pay for it. It's got a negative expected return, but if your house burns, you get the payoff. So yeah, we just routinely pay for that. And that's, again, it depends upon your preference, like how much you want to avoid that downside, and that will determine how much of the upside you give up. And that's what this is all about, figuring out what the risk preference is for the investor, and then designing a portfolio that optimally suits that risk preference, or in other words, gets the highest expected return for that level of risk.
And the risk topic is so hard, I think, particularly for individuals and financial planners, where a lot of people, they may not really know their risk until they've been through it. I mean, we'll often hear people say, yeah, I can handle 50% drawdown, no sweat, put all my money in stocks, and then don't realize that, going back to our earlier part of the conversation, that often market drawdowns occur. It also happens to be recession. They lost their job. They got excited, bought 3 houses. Kind of all happens at once. And then they say, wait, I can't handle 50% drawdown. I got to sell it because I don't have any money elsewhere. And so
you sell exactly at the wrong time. So you sell low, and then you end up buying high. So it's the opposite of what you should be doing. But that happens where, unfortunately, people don't do the planning that they do. They have to liquidate some of their portfolio at the worst possible time, and they lose the rebound.
So it's summertime. You got a curious mind. what else is on your brain these days? We didn't get a chance to talk about the great manure crisis of, 1894?
Yeah, there's a lot of things on my mind, and I've got a number of research papers that are ongoing. And one of them is called Faults and Misdiscoveries in Financial Economics. And it really has to do with not as much investing in a bad manager. You think about the mistakes that investors make. So one mistake is you invest in a bad manager and manager disappoints. Another mistake that's not as talked about is passing on a manager that turns out to be good. And there's kind of two related mistakes on top of that. You've got a manager in your portfolio, they've done poorly, and you decide not to redeem them because, oh, well, I think they're smart. Maybe they've just had bad luck. But it turns out that it's not bad luck, it's lack of skill. Another mistake is you've got a manager in your portfolio, manager's gone through kind of a rough time, and you decide that that manager is unskilled, you redeem, but that was a mistake because they were skilled. So all of these are different types of mistakes that really aren't talked about that much in academic finance. Usually we focus on investing in the manager that turned out to be unskilled. So that's the so-called false positive error. My research is looking at this other error and developing a new framework, which is, I think, intriguing. I know it's different, but it gives investors a different type of decision criteria so that you could have a decision criteria that I'm willing to miss 5 skilled managers to avoid investing in one unskilled manager. So that sort of trade-off we haven't really thought about before. And that is the topic of some ongoing research. I've got research looking at investment horizons that's brand new. And that, again, is just very poorly researched in my field.
This is an area of particular interest to me. And I don't know where you're going with this, but we spend a lot of time talking about this.
Yeah. So just even think about how we think about the measurement of risk. So if you're able to hold for a longer horizon, the actual risk exposure that you face is different. So this whole idea, we think of beta as the sensitivity to whatever factor or market return is usually measured over a monthly horizon. But that's not necessarily relevant for the investor that's holding over a longer horizon. And different investors have different horizons, needs to be taken into account. So it's very early, but it's very exciting. The theory is exciting, and we have some very preliminary empirical results that are exciting also.
Well, you mentioned earlier, and to tie this into a practical, I think for the younger people, especially listening to this, about, you said young people should actually be borrowing to invest. And I was giving a talk in Dublin and talking to a younger audience, and someone had asked something like, along the lines of, what's your best advice to some undergrads? And I said, the decision for you guys is to focus on, I think it trumps what you actually invest in specifically, but the fact that you choose to save and invest in the first place. And I said, but here is the challenge you guys will face. I say, you'll be coming up on spring break. I assume you guys do that in Ireland, and you have the choice. You either have the ability to go to Ibiza. I said Cancun, but that was more of a US focused example. I said, you can spend $2,000. However, the example I'm giving you is that you could put that $2,000 in an equity account, and in 25 years, if you compound at 10%, that $2,000 is now worth $20,000. If you hold it for 50 years, so by the time you're retiring age, that $2,000 is worth $200,000, assuming no taxes. And I said, so can the young 20-year-old have some empathy with the you 70-year-old and say that $2,000, is it better spent saving it or having $200,000 in retirement, and thinking about how to invest and compound? Now I said, actually, my advice is you should probably go to Ibiza because you'll have a lifetime of memories, and maybe that'll be better spent. But I said, it's a way to think about your life being young, is the biggest thing you have is the ability to compound on long time horizons. And the example you give of where the volatility of stocks on a 1-year time horizon versus the volatility of, say, stocks on 20 or 50-year time horizon, and the spread of percent outperformance versus other assets, is things that I feel like people talk about theoretically, but I don't know how it makes it into actual
implementation or policy for most investors?
People are not very good at compounding in general. So people not very good at exponents. And even people that you might think are skilled, that should be able to do it, people that might have masters or PhDs in quantitative fields, they're just not good at that. And it leads investors to make a number of mistakes in terms of their saving, where they are basically undersaving. These young people should have some leverage at this point. Most of the students in the business school at Duke are highly levered, and it's no problem getting that student loan because they make it back in a few years, given the bump in income that they get from their masters. But it's really hard to basically say to these investors, especially when you're young, that you need to give something up to invest for a time when you're 70 years old. That just doesn't go over well. The trade-off in terms of the time horizon, they just don't get. So the alternative is using leverage or tilting the portfolio. You think about it, they've got a small amount of savings. Often it's in a certificate of deposit or a bank account that makes nothing. So if there was a way to invest in a different way, and that's what we were talking about earlier, that investing in a broad range of different assets where there's no round lots, you buy a fraction of a share of IBM at very low fee and have a portfolio like that, where you're diversified across different types of assets. Some of these assets just not available today, but will be available. Like you own a piece of a self-driving Uber, 10% of a self-driving Uber, or you own 10% of a cell phone tower and you're paid in real-time dividends. So anytime somebody uses it, you're paid in real-time dividends. So there are all these assets that will be available. It's very exciting in terms of looking into the future and how asset management will change. And I've given this speech many times that this is actually a great period for financial advisors, because on one hand, you see the sort of robo-investment tools maybe eating into their business a little bit, but really not. It's more they're using the robo-investment tools and fine-tuning it for a client. But there'll be so many of these new assets that come on to the market that people will need some help. Yeah. And that's where they come in. And for the medium term, at least, there's just so many opportunities. But again, this is an issue. If you think it's a problem with these young people in Dublin and the lack of saving, you need not look very far towards, let's say, the unfunded liabilities of the US government in terms of Social Security and other obligations. It's hundreds of trillions of dollars. And that doesn't appear on the national debt. So there's no saving going on there either. It's a problem that has been a problem for generations. I don't see it going away, but I do see the possibility of these new assets coming online that will have high expected returns. Some of them will be risky in terms of they will have explosive upsides, where you have many people that might be able to invest in a piece of the new Google or the new Facebook, not just the select few. So right now, our system essentially reinforces income inequality. The best investments go to the people that have very, very large portfolios. So to get in line for private equity, for example, you look at the performance of private equity, it's nothing special, but it's diverse. So the people that get the best deals are the people with the biggest portfolios. So I see sort of, it's going to become much more democratic in terms of the playing field for investment. It's also the case, as I mentioned earlier, that we'll see a much bigger peer-to-peer sector. Indeed, I remember when my grandfather died, going through his portfolio, I noticed that he held a mortgage, which I said, oh, that I didn't know about that. So that meant that he had given somebody a loan to buy a house, and he held the actual mortgage. So he was playing the role of the bank. So he was undiversified in doing that, though maybe he knew the person and that helped mitigate the risk. But think of buying a fraction of a percent of thousands of mortgages diversified across the US or even across the world. So that way, you're going to get a much higher rate of return. There's no middle person. You're investing directly. The small business can go to the crowd for funding. So instead of that bank loan, the bank is asking like 12% for, they can be funded at 6% or 7%. And that's a good deal for them. It's a good deal for their investors because they're getting a much better rate of return than they could get buying a commercial bond or something equivalent to that. It also allows for small ideas to actually come to fruition. So there's so much stifled innovation in our economy and around the world because of so-called financial frictions. So it might be that the bank is charging a rate that's too high. It might be that the bank isn't even interested in you because the loan amount is too small. So if it's too small, it doesn't cover the fixed cost of the bank. So now all these microloans can be efficiently provided and surfaced in terms of the credit function of the bank, in terms of scoring. Well, that's a joke right now because just off the shelf, credit scoring algorithms that are free, available on the internet, are very competitive with what the banks are doing. So all this stuff is available. I do see the upside here, and the upside is the following, that I believe that we sometimes learn too much from history. And we think about economic growth in the world, the US growth declining. We're lucky to get that 3%, and who knows when we'll ever get to 4%. Europe declined even further. They're lucky to get 2 and more likely to get 1. And kind of the narrative is that as you become more developed, you expect the real GDP growth rate to go down. And indeed, just look to China. So it used to be they got 12% growth and a 10% and then 9%, and then now 7%, but still very good. But you kind of see, well, they're developing, therefore the rate of growth goes down. So I think that just extrapolating from the past on this is a mistake. And we know that GDP growth is very important for equity valuation. That's the numerator. So that's the cash flows of the firm, highly correlated with economic growth. But my narrative is different, and that is, with this technological change that's going on right now, we will dramatically reduce the frictions. So these small businesses that weren't small businesses because they couldn't get the funding, they get the funding. And they invest in their idea, and some of those ideas turn out to be really big ideas. We also allow for financial inclusion. So even in the US, an extraordinary number of people are unbanked. And around the world, you've got 2.1 billion people that are unbanked. So obviously they can't get a credit card and they can't do business because they're unbanked, unless it's a cash type of business. But with this new technology, everybody will be banked. You need a smartphone, and the smartphone is your bank. You carry your vault on you and the smartphone. So this allows a large group of people to join the modern economy, to transact on the internet, both buying things and selling things. And that's a big idea. So if you think of 2 billion people, that human capital coming onto the world market, that basically takes that declining growth rate in emerging markets and jacks it up with the discontinuity, the size of the Industrial Revolution, actually bigger if you look at what happened there. And what happens in emerging markets, anything that's positive is good for developed markets also. So I actually am very, especially bullish on emerging markets. And I believe that people have too quickly written off this very slow growth, that we're going to be stuck at 2% or 1%. No. They're not figuring in the positive benefit of the technology that we're dealing with today. And when that happens, we're operating in a world Just you think of financial institutions. They're the same today than they were 100 years ago. Nothing's really changed. The stock market is essentially the same. Yeah, we've got some electronic stuff, but it's still very, very clunky. Payments, clunky. Think of this. You swipe with your Visa or MasterCard, that's 3%, 300 basis points, right? That's a massive fee. And a gas station, even more. That is super inefficient. And that sort of thing will go away. Those transactions costs will become very, very small. That's all good. That's a shock to the economy. That 3% fee has been the same for 40 years. It doesn't make any sense. And we're seeing some credit cards get nibbled away where they give some points away, stuff like that. That does nothing compared to what I'm talking about. So when we can transact more efficiently, when all of these people join the modern world of the internet, we will see a surge in growth, which will be good for everybody on average, at least, and the stock markets.
Do you think this is like a 10, 20-year sort of transition? Do you think there's any scenario where a lot of this, there's like a dam breaking catalyst? Because we talk about this in the investment management industry, and I say, look, you can basically buy the global market portfolio with ETFs for essentially free. I mean, it's like 5 basis points. You include short lending, it essentially has a negative expense ratio. You don't have to pay commissions if you don't want to. Vanguard, Robinhood, all these other brokers. So I'm like, you can invest for free, but we live in a world where there still exists a 2% S&P 500 mutual fund. God forbid you go to Canada or Japan. Someone was talking about the average fees someone pays once you include all the intermediaries is like 4%. And people always ask me, they say, Meb, when's this disruption happening? Because every day in the media, you see, well, ETFs or low-cost funds, are eating high-cost fees lunch. I'm like, yeah, but it's like the high-fee stuff is still like multiples of size bigger, despite the fact that most of the evidence shows that you don't need to be paying these things. One more example, and then I'll let you answer, that I see as one of the major disruptions of the automated space is the fact that we did a poll the other day on Twitter. I said, what do you earn on your savings and checking account? It was, I don't know, 0 to 50 bips, 50 to 100, or above 100. And so it was like 60 or 70% were below 1. And the reason I mentioned this because Betterment just recently came out and Wealthfront, all these others are doing it, where they offer like 2.5% on FDIC insured checking accounts and savings accounts. So I said, I looked up my Bank of America. I'm a preferred client. Mine is 5 basis points. And to me, I think the automated service is really cool, but to me, you're starting to see these massive disruptions where, and going back to the fees, is like all these things happening. Is there something that causes it to actually like flush, dam break, or is it the way that I tend to lean, which is as people die, as people get divorced, as assets pass along, it never goes back? Do you have any thoughts on predicting the future?
It's kind of my job. So my job is to prepare my students to be disruptors in the future, not disruptees. So part of my job is to think about that future. And when I look at kind of traditional financial institutions, there's like a reason that you're only getting 5 basis points on your savings account or your checking account. It's basically all of the fixed costs of the infrastructure, all of the bricks and mortar, all of the money that these banks spend on security. Like cybersecurity is a major, major expense. So you're paying for all of this. And what I'm saying is the technology will change on so many different dimensions. So the cybersecurity will largely become irrelevant with blockchain technology. So that is a massive saving right there. You don't need the bricks and mortar. There'll be much more peer-to-peer. So that'll be good also. And the traditional banks, you talk about 5 basis points, try doing like a international wire transfer. And I did one recently to Canada, and I said, well, gee, what rate are you giving me? And they quoted a rate that was far away from the market rate. And I said, well, I'm a preferred customer also. So, okay, we can do a little better. So you need to ask for that first, which is really not fair. And they give me a marginally better rate. So they're making just a huge amount of money on a very simple transfer. So all of that is going to go away. It's going to go away sooner than people actually expect. This is not a 20-year sort of expedition. This is more in the 10-year time frame. Different countries will have different horizons. For example, you mentioned Canada. It's got essentially an oligopolistic, highly concentrated banking sector that would be very difficult to disrupt. But in the US, it's wide open. Yes, we do have some really big banks, but they're the ones that are most at risk. So these fees basically just take money out of the economy. So just think of that. So 3% was put into everybody's wallet today. That would lead to more spending. So it basically, this will happen over, I think, a time frame that's a lot shorter than people actually expect. Even though you don't see a lot right now, you will see it. And for the financial institutions, it will be a catastrophe.
Good. I'm looking forward to it. But I got the s'mores. You bring the matches.
But fees in general are kind of interesting. We talked earlier about it doesn't make any sense if somebody is underperforming and they're charging this really high fee and then trying to spoof potential investors saying that they've got this great product. It is also the case that if markets were reasonably efficient, that if you got something good, you should be able to charge for it. So you've got a good model, it's got limited capacity, and you should be able to charge a higher fee for it. And people doing the due diligence should be able to determine, okay, this is good, and I'm willing to pay the fee, because really all that counts is the after fee return. So it is foolish to look at the return of any fund before all costs are factored in. So I don't care if it's high fee. If they can deliver on a high fee, then that's great. But we also need to be careful about what deliver actually means. So you've got a huge number of asset managers out there that I classify as unskilled. And what they're doing is they are exceeding a benchmark, maybe the S&P 500, and all they're doing is taking on some known factor risk. And they get paid for it, which doesn't make any sense because again, on the fees, you can go to an ETF to get that exposure in a fairly passive way at very low cost, like the stuff that Research Affiliates does. That sort of product is ideal. It is very disruptive. So these products are designed to disrupt the unskilled managers that are just taking risk, and then investors are paying them for that. So instead of doing that, you get this very low cost ETF that delivers performance appropriate for whatever factor at a very low fee. So if you think of the asset management industry, I see two kind of forces in terms of kind of shaking out that industry. So one force is this low fee product that's designed to outperform a standard benchmark like the S&P 500. And investors can widely get that. And that really squeezes these managers that don't really have any skill. And then there's another force having to do with the technology where, given there's just so much information today, and it's almost impossible for the manager to digest all that information, we need technological tools that help us. And I'm talking about discretionary investors. I'm talking about systematic investors, that the very largest firms are heavily investing in machine learning tools to aid their investment. And these are fabulous tools. They can be misleading also if you don't know what you're doing. They can be misapplied. But I'm talking about the firms that are large enough to have skilled people operating these tools to provide timely information for their discretionary managers. And what that does is it causes a shakeout. So these smaller asset managers that can't afford to invest in the human capital that's related to machine learning, the computing resources that are substantial, and the data. And data is not free, it's expensive. Anybody who says it's free, they don't know data science. Just the cleaning of the data takes a lot of time. So these larger firms have the economies of scale to actually do this. And what we'll see is kind of a concentration, which I think is good for investors, because when you put these tools to the data, it can really help the manager in terms of what they actually select. So those two forces are really attacking small and mid-size asset managers. So the low fee stuff doing basic ETFs on the factors, and the firms that might be able to charge a higher fee that are really squeezing something out that is not obvious, just eyeballing the data or using whatever spreadsheet to look at some company's valuation. So you see that bifurcation.
A couple comments. One is that when we think about fees, we always think about them as just like a high jump bar. The higher fees don't mean you can't outperform. I mean, look at the famous example of Rentec or some of the most famous hedge funds. It just means it's a higher bar. And as a default, when we joke with listeners on this program, I said, if we ever get to 5-10 billion, I used to say 10, now I say 5. I say, I'm going to launch a fund and we're going to do the old, was it Wall Street Journal, the DART portfolio? And I said, we're going to have a party every year. The 100 people can come that are shareholders, throw darts against the wall. We'll pick our portfolio for the year. We'll launch it, low fee portfolio, and just to kind of troll the whole industry, because we'll equal weight it. We're not going to market cap weight it. So that'll give us a little bit of a tilt towards a couple of things that should help against market weighted portfolios. But I, for one, am looking forward to all the developments. It's hard. I mean, Charlie Munger often says, a student, I mean, he's in his 90s now, asked him for advice, and he's like, I'd be a fisherman. You go where the fish are. When you think about a lot of these funds and data sets, it's probably not going to be doing research in the US on some large cap stocks. And maybe you're going to become a frontier market analyst in Nigeria or somewhere else or new asset classes and different ones. Cam, we got to start winding down. We've kept you for a long time. We haven't even talked about 100 of your papers yet. So we'll have to have you back. We winded down with a couple other quick questions that people love to answer. One is looking back over your career. And this can be personal, it can be involved in really anything. We like to ask people, what's been their most memorable investment? It could be good, it could be bad, it could be both. It could be just the one that's just seared in your brain. Is there anything that comes to mind?
My best investment was to kind of go against my family's wishes and go to the University of Chicago for a PhD. They totally didn't understand that. I was the first one with a bachelor's degree and then a master's. And why do you need that? So that was probably for me to go to the University of Chicago at that time, the best investment. And this is consistent with our conversation that we need to include human capital in the investment. So that was an investment of my human capital that turned out to be a pretty good investment. The best trade that I ever did was when the yield curve inverted in mid-2006, I went 100% in cash.
Uh-oh. Ominous.
Yeah. And that turned out to be a great one. And I guess recently, when I started teaching my blockchain course, I bought some Bitcoin very cheaply. I wish I bought more.
Yeah.
But that had a spectacular upside.
That's funny. Yeah. You got to have some skin in the game when you're teaching it. I totally whiffed the whole crypto. We actually had it on one of our research portals for a payment source that people could pay. But this was like 2014 or something, and no one paid. I'm like, this isn't interesting. No one's using it. Obviously not the right use case of people paying for things where you could pay for a credit card. Both those are great. You know, it's funny. I have the exact opposite, but probably worked out where my brother had gone to grad school at University of Chicago doing a PhD, and it took him like a decade. And when I graduated college, I was originally going to go directly. I was a biotech guy, engineer, and I was originally going to go directly to PhD. And he's like, Meb, you're young, take a couple of years, make some money because it's going to be a long slog. And then you can always go back. And then kind of went to the finance route and started in the investing. This is the year 2000. So a lot of bubbles.
But it's worked out.
It's worked out so far.
Yeah.
It's in a different way. You know, my hobby is a career and vice versa. Cam, where do people follow you if they want to see everything you're up to, your writings, your goings-ons? What's the best places?
So there's many different things you can do. At Cam Harvey is my Twitter handle. And then you can find me on LinkedIn. I'm using that more than I used to because it's a convenient place to put articles. And so I'm using that. Also, just Google me. My webpage is got all my publications and my teaching material. Everything is online.
We'll add all the links to the show notes at mebfaber.com/podcast. Cam, thanks so much for joining us today. It's been a blast.
Yeah, great to be on the show.
Hey, podcast listeners, we got another great show for you today. We invited our guest back. He was with us on episode 46. With all the macro gyrations going on, I want to talk to him and get his take on what's happening, what to do. Former PM of GLG, Goldman Sachs, before he retired from the headache of other people's money, managing it. He now writes Global Macro Investor and CEO, co-founder of Real Vision. Welcome back to the show, Raoul Pal.
Thanks, Meb. Pleased to be here.
How's the world look from you on the shores of the Caymans? Is it full-on summertime there? How things down that part of the world?
It's hot and hell, gets a bit steamy. We get a bit of rain, but don't forget, we've got a turquoise, crystal clear sea in front of us, so I can't really complain.
You know, last time I was down there hanging out with you, Zika was big in the news, and I'm not sure if it was a lot of hype or if it was something that just was mostly a tourist concern. Is that something that's kind of blown over, or is it still in the back of the tourism industry to take a hit? What's the update on that?
Actually, interesting enough, we've just been certified as Zika-free, so we've had a huge pickup in tourists because a lot of tourists were avoiding going to Zika countries, but the Cayman Islands is now free of it. So, yeah, we've had that massive pickup. Really interesting. Before then, I had friends of mine who wouldn't come down here, particularly if, the wife was pregnant or, they were looking to get pregnant or whatever. They definitely wouldn't travel.
Last time I came down there, my wife was pregnant. She was joking because my work trips, for whatever reason, she's like, dude, you're doing a Zika world tour through like 6 countries that you should not be going to. We gotta keep an eye on this. Anyway, everything came out okay. So we got a lot to talk about. The world finally, I feel like, is starting to get pretty interesting with a lot of macro moves. You have a tweet that's not evergreen, but every once in a while it pops up in my feed that I love and would love to hear you talk about it. But you say, buy bonds, buy dollars, wear diamonds. What are you talking about there?
Well, to say, when you said there's a lot going on, the technical term we use in global macro trading is there is a shit ton going on right now. There is so much going on, I can't even get my head around it. The point being is, at a very top level, is global growth is slowing. We're in the longest expansion in all recorded history in the United States and in several other countries. We are seeing Europe going into recession. We're seeing countries like Australia going into recession. We're seeing Asian countries in recession. We're seeing China heading towards recession, and the US growth slowing, and forward-looking indicators of the business cycle suggesting the US has a high probability of going into recession. It's not there quite yet. So as a macro guy, I've learned that the best thing you can do is not follow every single opportunity, but distill it down into what is the most perfect opportunity that there is. And when you look at it, very few people understand this. Everybody wants to short equities and do all this kind of clever stuff or buy CDS or whatever it is. When actually, one thing is central banks are kind of Pavlovian. So as soon as this happens, they start cutting rates. Now, we also know that generally, once the central bank cuts rate once, the Fed have never only cut rates once. So it's always been at least 3 times, and that's in a mid-cycle slowdown. Now, considering this is the longest expansion in all recorded history, the chance of this being a mid-cycle expansion is close to 0. So if it is a full rate cycle, i.e. we're going into recession, then interest rates are going to 0 and maybe negative. So what does that mean for equities? Well, we don't actually know. Equities have been very buoyant considering. Usually it would mean that equities fall. We don't know if the prices have been distorted by central banks or not. I don't really buy that argument. But for argument's sake, we don't know. I also know that trying to short an equity is a volatile and difficult task of which you usually end up losing your arse and not gaining any P&L in exchange. Because what you basically get is you get something that goes from being a low volatile instrument. Equities, have been around, let's say 10, 12 volatility. And before you know it, they're at 40, 50 vol. And your returns are less than the volatility. So you struggle to make any kind of high quality returns. Now, when you get to the short end of the fixed income market, which is the buy bonds part of the equation, that does extremely well indeed because the yield curve tends to steepen over time after it's flattened, and the front end of the curve just goes down as the Fed cut rates. and the market starts pricing it in. As you're seeing every day, it's a relentless bid to Eurodollar futures, which is the very front end of the market, or even 2-year note futures. And that trend I've noticed in my kind of 30 years of my career is the single lowest volatility, highest return trend in the world when that happens. And this is where people like Stan Druckenmiller, when he came on Real Vision, this is what he told us. He said, look, the dirty secret to him making his money, particularly in kind of bear market years, is nothing to do with equities. It's all trading Eurodollar futures or 10-year bond futures. So once you identify the cycle is going lower, you can identify the highest quality trade as the bond market. The dollar trade is somewhat different to that. That's the fact that the world is short 13 trillion US dollars. Those are foreigners who borrowed money, according to the BIS, and they've borrowed dollars. That tends to be Chinese companies, South Korean companies, European banks, European corporates, and a bunch of other entities. That is a complicated situation. One of the reasons why everyone keeps saying, well, the Fed are going to cut rates and the dollar's going to fall. Suddenly the dollar doesn't fall. In fact, it keeps going higher and it keeps exploding higher and then trades back and goes higher again. And it's because all of these people are short dollars, and there's a shortage of dollars in the system because of quantitative tightening, which is now ended. Then there's the tightening that's about to start, which is due to the expansion of the debt ceiling and the replenishment of the Treasury General Account, which is a slightly technical thing, but basically is about $600 billion of withdrawal out of the money markets. And then there's the regulatory changes that came with Dodd-Frank and Basel III. All of those have meant there's no funding abroad. So the dollar keeps going higher. So as the world economy gets worse and trade tariffs go up and world trade slows down, there's even less dollars around. And so the dollar drives higher and higher and higher. So those two trends, when the dollar starts trending, it's a very low volatile, very high reward trade. So again, in terms of the quality of trade, it's extremely high. So in this environment, buy dollars, buy bonds, wear diamonds. And the reason wear diamonds, this is an old kind of 1980s markets expression. And it came from the fact that if you buy bonds, you'll make enough money that you can wear diamonds. So there you go.
The millennial version of that is the conflict-free, lab-grown, maybe wear diamonds, cubic zirconian. A couple interesting things about this, because I think a lot of listeners may get stuck up on the fact that say, oh my God, why would you be buying bonds when they're yielding such a low amount? I think it's hard for people to wrap their head around the fact that almost no one back when bonds 10-year was bumping up against 2.5%, 3%, this prospect, most people thinking that they could go back down to lower amounts. We have an evergreen tweet I pull out every few years where I think it's from like 2014 or 12. It's like, wake me up when the 10-year hits 50 bips, as this kind of just comment on what's possible. So talk to us a little bit about that, because a lot of our momentum sort of signals would say had been allocating. I mean, bonds are having a monster year. Forget about 30 years or zeros. Could you see the potential of the U.S. joining the rest of the world, which every day seems to be more and more, not just sovereigns, but even some corporates, in a potential negative yielding world? And talk about that from the framework of a macro guy who's been around for a while, because, had we transported back 20 years, maybe would have said, that's an odd place to be in the future when all these bonds have negative yields. Any thoughts there?
There's a number of bits I need to unpack of that. So why bond markets are so interesting is, yes, you get good price appreciation at the long end. And everyone goes, well, why would you buy the short end? Well, the fact is when you start trading 2-year futures, or particularly Eurodollar futures, which are 3-month rates, and you can choose what expiry. So I can choose whatever I think the LIBOR 3-month rate is going to be for December 2020. So that's very specific targeting of rates. I get enormous leverage. So each contract, you put down $2,500 margin and you get $250,000 of underlying exposure. So you get enormous leverage within these contracts. So because they're low volatility, you can take large positions. And that means that you can make extraordinary sums of money. They also, even better than that, have options on them, and they're incredibly liquid. In fact, the Eurodollar market is the most liquid market on earth.
And not to interrupt there, we haven't talked a whole lot about Eurodollars here. So for those who aren't familiar, give us just a brief overview of Eurodollars and why this is a market that's of particular interest to you.
Yeah, so Eurodollars, it's a weird term because everyone gets confused with the currency. It's nothing to do with the currency. What it is the world is set up that There are dollars that are borrowed and issued within the US banking system, and there are dollars that are created outside the US banking system that are borrowed and lent using an interest rate called LIBOR, which is basically follows roughly what the Federal Reserve rate is, the Fed funds rate. But that rate is a free market rate, apparently. Everyone was done for manipulating it in the past, but it is supposedly a free market rate of which almost all money market instruments are set off against. So that is LIBOR, and the euro-dollar future is the future rate of LIBOR. It's the price of money, or the interest rate at which money is bought and sold or lent in the global system outside of the US, basically. To make it more confusing, these things are traded in the US, so it's the global price of money. So when you see a contract that's priced at, let's say, 98.5, what that means is you take 100 minus the price. So 100 minus 98.5 is 1.5. It's pricing that interest rates will be 1.5% by December 2020. So they're very simple as that. Theoretically, and this is the other part of your question, they could go to 100, which would be rates at 0. But actually, we've now got to a world where that's not even true any longer. They could go to 102, 104, 105. There's a realistic chance that US rates go negative. Now, it seems that to me, and this is my big macro perspective, is that the predominant driver of interest rates is inflation. The predominant driver of inflation is demographics. And the demographics of Japan peaked first, and rates collapsed and went to 0 and then to negative. They were followed by the demographics of Europe, which was the next oldest set of countries, and interest rates collapsed and then went negative. And the final part of the equation is the US. And the US looks like it's got a slightly younger population, but as the average baby boomer starts heading into retirement, interest rates, inflation are going to collapse to 0, and interest rates in the US will tend to go negative. So it seems that there is a catch-up that will happen. That spread has been one of the reasons the dollar has been so strong. It's not only the reason, but that spread of interest rates between countries. So my view is that I would never have believed that interest rates could be negative, but now I'm seeing it at corporate bond level as well. I'm trying to get my head around it. And my job, or our jobs in financial markets, is not to necessarily question why. It's to understand, okay, what is this saying about the situation now? And what do I have to do to invest around it? So that tells you that bonds could continue to rally. In fact, I think my target on the US 10-year for a long time has been 0.5%, but I actually think they go negative. So that's the US 10-year yields could go negative. So that means there's a huge potential rally to come. So that gives you a different look at your asset allocation. Sure, you might not get a high yield, but my God, you can get some capital returns out of it. And the same is true in Europe. Bunds have been terrible because on paper, they give you a negative yield of 60 basis points. The reality is they've been in an enormous bull market where price gains completely dwarf the lack of interest, or the opposite, the cost of buying these bonds. Because that's what it's come to now. You're lending money to governments at a cost. And why is that? At a macro perspective, it's telling you there is something more broken within the system, that demand for money is not what people think it is. And I know many people think it's a function of central banking. It's probably not as much a function of central banking as a function of debts that we're allowed to build up, plus this demographic. But it's interesting that people now perceive bonds to be so safe that they will pay money to be parked there. And somebody argued on Twitter the other day, and I think interestingly so, is if you go to a bank and have a safety deposit box, you actually pay the bank for that. So why necessarily would you not do that with a bond? And I'm kind of like, yeah, I can see theoretically maybe we just had an anchoring bias based on what we knew, even though it's never in world history before if we've seen negative bond yields. So it's a really complicated world in macro out there trying to figure this out, but it's very exciting.
Well, that's what makes it interesting. I think you might be referring to Joe, who Weisenthal, who caught a lot of flack for that. You know, and that may be part of why it's a structurally or behaviorally potential good trade, where you listen to probably the listeners of this podcast are saying, oh my God, a possibility of buying U.S. government bonds if they're yielding 0.5 or 0.1%. I would never do that. But then, there's two sides of the bond coin. It's not just the yield, of course, but the potential price gain or loss, and I think that's a struggle for a lot of people. You're a longtime PMI guy. If we had a hat for you, it'd be Mr. PMI. No one loves the business cycle and kind of everything going on with ISM and everything else around the world. You had a couple good tweets about that. Give us an overview of what the PMI is for a refresher, and then what does the world look like? Is that signaling anything good, bad, or in between?
Yeah. So I look at the world in terms of the business cycle. What staggers me is most people don't. So most economists look at a linear extrapolation of future, but you can bring a small child a chart of US GDP or global GDP or any country, and bizarrely enough, it goes up and down, which tells you it's cyclical. Yet economists never forecast a recession and they never forecast the boom. They just forecast what they know. And it's a kind of odd situation. So a long time ago, I started looking at this and trying to understand, okay, how can I understand the business cycle? Firstly, to know where we are, and then to forecast it. Because if I can forecast it, I know it trends. And I know that like a sine wave, it goes up and down. If you figure out when the sine wave has rolled over, you know when the next recession is coming within a parameter. And that's when I look at probabilities. You know that the average expansion is a certain number of years. Let's call it 7 to 9 years. So you know that by about 7 or 8 years, you need to start looking for that rolling over of the business cycle and the potential extrapolation into a recession in the future. And the reverse, once we've had a recession and it starts rolling up again, you're starting looking for that expansion and the opportunities that will offer you. So what I use for that is something called the ISM. I've actually moved a bit away from the ISM and use something called ECRI, the Economic Cycles Research Institute, weekly data, which is free. You can find it on their website. And ISM you can get pretty much everywhere. And the ISM is a survey of purchasing managers. So PMI stands for Purchasing Managers Index. There's a whole bunch of these globally. It's a survey every month that asks purchasing managers what their business conditions are like. Are they buying stuff? Are they selling stuff? Do they have much inventory? What's their confidence levels like? All of those, what prices are doing. And that gives us some granularity. And oddly enough, it maps very, very well indeed to GDP. And what is really interesting is all the PMIs around the world map very well to their own GDPs. So they're very useful. And the ECRI is the one I use now, which is actually composed of a number of different economic data points. But that actually mirrors ISM. So let's use the PMI or ISM going in this discussion. So the question is, what use is that? Well, when you look at these things, you've learned that if you put the year-on-year rate of change of the S&P 500, for example, it actually exactly mirrors the business cycle, the ISM or the PMI. And if you look at the year-on-year rate of change of bond yields or of copper or of oil or of most things, and most assets, in fact, just follow the business cycle. So the business cycle is the largest driving factor of all asset prices. Now, embedded within a business cycle is everything from the credit cycle to demand for risk and a whole number of things. So it's very consistent. So that's pretty useful. So I use that. And then I can then compare around the world what's going on. We know, for example, that when a PMI crosses 50, that it's telling us that the data is contracting and therefore we're getting closer to recession. Normally, a recession is seen when the PMI gets to about 47. And then you can get to a really bad recession if you start to see a PMI get down to the high 30s. Now, currently around the world, global PMI, which is an amalgamation of all of them, is at about 48. So we're very, very, very close to a global recession. In China, we're about 50. But the Chinese data is not very pure. It's been kind of manipulated, so we don't really exactly know. But it's around 50, so we're going nowhere. It's slightly contracting. Maybe it's 47, 48. We are seeing Europe, Germany, we're seeing its PMI in free fall. It is now down at 45 or so. And that's telling us we've got quite a significant recession underway in Germany. And we're seeing the PMIs across Europe also falling. We're seeing the UK falling, we're seeing Australia falling, we're seeing Japan falling, we're seeing South Korea falling, Singapore falling, we're seeing India falling, we're seeing Brazil falling. No, Brazil is rising, we're seeing Argentina falling, we're seeing the US falling, Canada falling, Mexico falling. So what we have is a synchronized global slowdown, and it's being shown in real time in these PMIs. And that tells you, once you start looking at these, that the year-on-year rate of change of asset prices is going to start grinding to a halt and then very quickly becoming negative. So we're now at that very tipping point where if this data starts going a little bit worse, we're going to start seeing negative returns from all of these equity markets, particularly in the US, which has been very close to its all-time highs. So there's a lot to play for. It also tends to suggest that interest rates will go lower and lower and lower, and that commodity prices tend to collapse. And that links back into the dollar, which tends to be part of that as well.
I bet a lot of people who are listening are probably listening to this podcast, taking a drive and saying, it feels weird because in the U.S., as I look around, it seems like inflation is low. It seems like the economy in many ways is booming. It seems like employment is super low. And, you hear a lot of people say, what all of a sudden the Fed is cutting rates. And part of this may be because of what a lot of things you talk about, where the rest of the world, there tends to be a lot more dark clouds. Talk a little bit about, you mentioned commodities as one piece of the puzzle. And we've seen some kind of big moves going on in the commodity space in various subsectors of commodities. Is this the deflationary impacts going on? Is it something to do with tariffs? How's a lot of this global sort of recessionary concerns? What are the main drivers and what are the implications for commodities?
What is going on globally is as the dollar goes higher, the dollar is the denominator of prices of commodities. So, i.e., for example, oil is priced in dollars per barrel. So if the dollar goes up, then the price of oil goes down against it. So that's a common factor because it is the price denominator. So as the dollar's been rising, commodity prices have been falling. So everything from copper to agricultural commodities to oil have been falling in price as the dollar's risen. But something else goes on is as the global economy slows down, as world trade slows due to tariffs, what you find is there's a less demand for commodities. Remember, the big commodity buyer was China, and China's basically in recession right now. Japan is close to recession, Europe's close to recession, so nobody's buying commodities. So that means that you tend to see price falls, and the prices can fall pretty sharply indeed. So when I look at that confluence of events between the deflationary factors of the dollar and of globalized demand, it makes me think that oil may fall to, firstly, somewhere maybe in the mid-40s, and I think eventually into the $20 a barrel range, which is an extraordinary, it sounds outrageous, and that I'm going for sensationalist headlines, but it's basically an extrapolation of the chart. I use a lot of charts, and understanding the potential movements of the dollar and what's going on in the global economy. That would be consistent with a global recession, which looks like it's happening. So that plays back into the US. See, the US is a weird fish because it's very consumption driven. And so what you'll hear at this point in the cycle is three things. You'll hear, well, the ISM, which is a manufacturing survey, that doesn't matter anymore. The US is an 80% or 75% services-led country. So manufacturing doesn't matter. Secondly, they'll tell you that consumption is everything and US consumption is high. Just look at the recent consumption numbers. Then they'll say employment. They'll say, look at employment. We've got record low unemployment. Everything is perfect. And in theory, that looks great. The problem is all of those data points are pointing to things that happened 18 months ago. You see, those things are lagged versus things like the ISM. So if you put consumption or employment against the ISM, it lags between 18 and 21 months. So it's telling you back then, when the Fed were hiking rates, they were right to do so because employment was very strong. Problem is now the forward-looking indicator tells you that employment and consumption are not going to be good going forwards, and that interest rates were wholly inappropriate for what the economy could bear. So that data is going to weaken over time. So everybody's looking at the wrong thing. The other thing that's really important here is also the manufacturing index. The services index lags the manufacturing index. So that too is you're looking at a data point in the past. But what we've got is this risk that oil rolls over. Now, oil is important because the US is now the world's biggest exporter of oil and the world's largest producer of oil. So that drives the manufacturing cycle, and a lot of the job cycle and a lot of the cash cycle and expenditure cycle of the US is driven by the oil patch. Now, if the oil price falls, then you start to have problems because oil production is still an expensive business, even with the technological advantage. And before you know it, very quickly, great profits out of that sector go into big losses. And the problem is that sector has a lot of debts. So that suddenly starts to tip, if you're not careful, the employment situation. And it starts tipping the consumption, and it starts tipping forward into other areas. And if that happens, then suddenly people buy even less cars. Cars are already pricing in a recession. And they start buying in less clothing, and clothing's already pricing in a recession. And they start going out to restaurants less, and restaurants are already in recession. So that whole situation is not looking good. And all the forward-looking indicators are suggesting that US GDP growth going in the next quarter or two will be at close to zero. It's not yet suggesting recession, but I'm extrapolating the trend and assuming that it's going to follow the rest of the world.
Yeah. I mean, if you look at another indicator, which Cam Harvey wrote about this in 1986, about the yield curve, people can argue about it till the cows come home as to why it may be different this time. But no matter what, you can't really say the yield curve is a good sign or signal, and it has a pretty phenomenal track record of predicting recessions, particularly in the U.S.
I remember very clearly the last two yield curve inversions because I was, very active in financial markets, very active in macro. One, I was running my own fund at the time for GLG, and then the second one in 2008, I was writing for Global Macro Investor. And 2008 was incredible because there was the housing issues going on. Everybody said the yield curve inversion is just to do with mortgage hedging. It is different this time. And this time around, we have the same discussion about it's the central banks. It's different this time. It's not different this time. The bond market is much bigger, much more powerful, and is the best single predictor of economic conditions. Bonds are always right. Well, almost always right. The only time I've ever seen the bond market wrong was 1994. It can be wrong by a little bit. There can be corrections, but nothing where it's really wrong. Not like equities that suddenly can show over a 6-month period a 30, 40% loss as pricing was unrealistic versus underlying conditions. Bonds tend not to do that. And the bond market's screaming at us that there's a recession coming.
Yeah, and you're starting to see it in some other countries that haven't seen one in a really long time as well. I think Japan may have tipped over at this point too.
Yeah, I saw that yesterday. It's like, that's incredible that Japan, who's not had an inverted yield curve since 1990, has now gone inverted. What's also extraordinary is its yield curve, along with that of Germany, Denmark, and a whole bunch of other countries, is at all points negative and inverted. And this is just extraordinary.
I'd love to go back and read the finance textbooks, try to tell them to put that a chapter in from 10, 20 years ago about the negative yielding inverted yield curves as a chapter. I think every professor on the planet would say you're crazy. So a couple of the things you've talked about that I think are pretty interesting. There's one where you've talked about the doom loop. People listening will probably say, is he talking about, is this a Elon Musk? Is he negative on the Hyperloop? Is this a reference to a Beastie Boys old song? Remember the old Flute Loop? What a great song. Anyway, what's a doom loop? What's it referencing?
In every recession, you need the bad boy. What is the thing? The one thing. The one thing was in 2008 was housing, and financial debt was part of that. So the financial markets blew up, the households blew up, and the banking system blew up. It was all related. In 2000, the recession was all to do with the equity market and the excessive borrowings and kind of speculation and hubris that came with an equity market that had gone to all-time record highs in terms of valuation. So what is it this time? Because you need to pin it on something. And it could be about central banks and it could be about negative yield curves, but it's always about debt somewhere. So what is the debt in the equation? The one that didn't blow up is the corporate debt pile. The corporate debt pile doubled from 2009. Unlike any of the others, government debt didn't increase significantly, and nor did, it increased, but its rate of change was not that big. And we had household debts actually were reduced. Yes, we had credit card debts that increased. We had a few debts, student loans exploded. But the real monster was the corporate debt market. So what's interesting about the corporate debt market is as more and more companies issued bonds, their credit quality went downhill. So AAA is the highest quality. And many years ago, there used to be a lot of companies with AAA rated debt. There's virtually none now. But as they've issued more and more debt, as the corporate sector in the US, which is something like 93% in debt, it's about 75% in debt in the US alone, as a percentage of GDP, they have lowered their quality down to triple B. And there's 4 trillion triple B bonds in America, which is enormous. What is that all about? So where does this corporate debt come from? The corporate debt comes from buybacks. So because interest rates were so low and there's a stupid tax ruling, corporations can basically issue stock options to their management and then issue debt and buy back all their shares. They all get rich. Their shares go up just because there's less of them. So their market cap doesn't move. And what they're doing is actively destroying shareholder value over time for the sake of showing some taxable profits. So that goes on, and they start massively changing the balance sheet of these firms, and the firms start getting downgraded. But who cares? The equity market's going up. Everything's fine. We're in the right part of the business cycle. But the other part of this is who these bonds sold to. Well, the bonds have been sold to the pension system, because the pension system has been in a big mess. It's got a big black hole as it's not managed to generate the returns that it promised its underlying pension holders. So those pension holders are not going to get the money they expect back. So in a bit of a panic, the pension sector has taken enormous risks. And that's holding too much equities versus bonds. And when they hold bonds, they want as much of this corporate bond, triple B and junk bond stuff as they can get their hands on. Okay, that's all well and good. The other problem is who's the biggest buyer of triple B? Well, it's the state pension systems like Illinois, the firemen and teachers and all of that kind of stuff. And all of those states which were bankrupt and had the big black holes, they started taxing their population in order to fill the pension black holes. So took it directly from the voters and put it back into the pension system. Okay, that's fine. That inflow went directly into corporate bonds. They bought the corporate bonds, the companies sold them, bought back their own equity. Problem is, the corporate profit cycle and cash flow that generates the buybacks is almost 90% correlated with the business cycle. So if the business cycle goes any lower, the buybacks stop. And that's the biggest buyer, in fact, the only buyer of equities in the world, in the US, leaves the building. It's the corporate buyback. All other sectors are net sellers of equities as the baby boomers go into retirement. The other side of the equation is tax receipts are 90% correlated to the business cycle. So the moment the business cycle goes down, the biggest buyer of bonds, in terms of corporate bonds, leaves the building too. So you end up in a situation where there's no buyer of equity and no buyer of bonds. So, and you've got a business cycle that is not good. So that is going to start to create an enormous problem. Because as that happens, there's likely to be a downgrade. Somebody's going to get downgraded from triple B to junk bonds. Okay, why does that matter? It matters because triple B holders are these pension companies, or pensioners in the end, and junk bond are different owners. And the junk bond market is only $1 trillion, and these triple Bs are $4 trillion. So if you downgrade 20% of the triple B market, which easily could happen, you're totally screwed. There's not enough buyers of junk bonds. So the entire junk bond market goes into paralysis. And that would mean a complete seizing up of the entire corporate bond market in one go. And I think that is a pretty high chance. So if that happens, then what happens is the business cycle goes lower. That means there's no buyers of equity at all. So the equity prices fall. So as the equity prices continue to fall, who are the big issues here with triple Bs? Well, there's 5 firms. It's Dell, it's GM, it's Ford, it's General Electric, and it's AT&T. So 5 companies, if their share prices start falling, and let's use GE as an example of a terrible firm whose share price keeps falling, if that continues to fall, they'll get downgraded. So then you increase the cycle. And what happens is, as the business cycle gets lower, these corporations stop spending, the business cycle gets worse, and the doom loop starts seeing spreads widen. And then you've got no buyers of bonds, and everybody is a seller of corporate bonds, both at triple B level and into the junk bond level. And there's nobody at all who's in a position to take the other side of that. So what you end up with is a larger and larger black hole within the pension system, of which eventually, once you get in this downward spiral of equities versus bonds versus equities, as you keep going round and round and round in the doom loop, you end up with a central bank having to step in and underwrite the pension system. Because if not, you've lost all of your voters, which is the baby boomers, all in one go, are going to go bust. So you've got some big losses to come out of the pension system. The government's going to have to underwrite it, and it'll have to be the central bank that does it. And then somehow, we don't know how they're going to finance that whole situation. But it means that the likelihood of quantitative easing and a large increase of the Fed balance sheet goes up dramatically. So that's the doom loop. It's something I'm really worried about because I'm very worried. I think we've talked before in the past about the demographics and the issues with the baby boomer retirement, with average baby boomer being 65 years old. You're about to wipe out their savings if you're not careful. And it all happens around a recession. Now, it's fine if you're 30 years old and you lose 50% of your pension because you just continue to add to it over time and you compound your wealth and it'll all work out okay. But this time around, the largest population in all recorded history, with the largest amount of money in all recorded history, all retire at the same time and don't have a job. So in which case, how the hell do they buy the dip? They can't. So it's a really, really dangerous setup and something that I'm hyper-focused on.
So we've talked a lot in the past about the pension fund system, and I just continually shake my head. We wrote an old piece called something like Pension Funds Investing with Eyes Closed and Fingers Crossed. They come up with this magical 8% return figure, which, in a world of 4 or 5% inflation makes a lot more sense than a world of 0 or 2 inflation. And targeting arbitrary nominal returns is such a strange concept in my mind versus they saying, the real target should probably be, inflation or short-term bonds plus 4% for a spread on equities or whatever they invest in, which, knocks it in half. And of course, they don't want to do that because they have to put a lot more money into the funds because they're underfunded. You mentioned Illinois. Illinois is certainly going to be probably problem child. And so what do they all do? They all have found private equity as a savior in this cycle, which seems like it could be one of the driving factors. All this discussion makes me want to go launch a tail risk BBB bond inverse fund ETF. Maybe we'll look into that.
It's a huge problem. And these pension funds have taken too much risk. So now what they've done is gone from triple B and junk because they drove yields down so low. They then drove down hedge fund returns by the same process because they crammed into the largest hedge funds and said, we don't want your volatility of returns. Lower your volatility will give you more assets. So they crammed down the returns of the entire hedge fund industry to now be a 5 vol 8% return product to look like high yield bonds. So they destroyed that business. And then they went in massive amounts into private equity. Now, the problem is the hedge fund industry and the private equity industry is totally illiquid. So come a need to pay back these pensioners, they're going to have to liquidate everything else. They own a lot of equity and they own a hell of a lot of corporate bonds. So the more corporate bonds fall, the more they'll have to sell because they don't have anything else where they can access liquidity. So I think that's a huge problem. So an easy way for people listening to this podcast say, well, how the hell do I hedge myself? How do I trade this? So my answer to everybody and everything, every instance is the best trade in the world is Eurodollar futures because the Fed are going to have to cut to zero and through it. If you don't really understand those 2-year bond futures, they're fine. If you don't understand that, TLT, ETFs, even that's easy. And if you're feeling a little bit racy and you don't mind a bit more speculation, then just buy some puts on the HYG because the HYG is basically high yield and high yield is going to get obliterated if that triple B thing works. But you're right. The opportunity here is somebody needs to set up a tail risk fund for this and then go back to these pension funds and sell them back the tails.
Yeah, say here you can hedge your garbage.
Yeah, they've sold the tails and they need to buy them back again. And so a hedge fund manager could basically create a good income stream by creating the tails back for all the pension industry.
That's funny. So there has been a couple bright and shiny places in the markets this summer, and one of them is to see the gold bugs start to come out of hiding, where gold is starting to creep up a little bit. Any thoughts on the precious metal? And as an extension, feel free to answer that question with the newer form of potential money and the millennials' love of crypto. So any thoughts on either or both of those spaces? What's going on?
Yeah. A lot, actually. Gold to me is just a currency. It trades the inverse of the dollar because it's priced in dollars, but it is a currency. It trades like a currency. And it did nothing for, 6 years, 7 years, as it digested a huge move that it had. And then it started breaking out versus various currencies. So it was becoming a strong currency. As interest rates went negative around the world, gold with a very slight negative carry, i.e. it costs you a bit to store the stuff, was, relatively attractive as a place to store your money. So, okay, that makes sense. And then suddenly the markets realized that, okay, if we're going to global recession, or we've got a probability of a global recession, we have to price in the probability of what are the central banks going to do. And ordinarily, I don't really care about that. Why I don't care is that's the reason gold fell in the last recession. The dollar went up, gold fell, because we weren't near the end game where the central banks did something that made gold the only asset you could own, or one of the only assets you could own. But this time around, it's getting interesting. And it's getting interesting because of Japan. Japan already owns about 70% of its government bond market. It owns most of its ETF market. So if Japan, which it is, goes into recession, BOJ are going to have to do something. What on earth are they going to do? Are they going to put interest rates negative 5%? Sure, they could give that a go. But the most likely outcome is they're going to have to buy all their bonds in quantitative easing. So if they buy all of their bonds, then they're going to write them off. And that's called a debt jubilee. How's that possible? Well, it's just an accounting trick and it's doable. What does it mean? It means that probably their currency collapses because there has to be some mechanism to reprice risk. And if they're saying government bonds were worth nothing, we bought them all back and therefore we can default on stuff, you generally will see some other macro variable move significantly. It's probably the currency, which will be great because it'll generate a bit of inflation for Japan. It'll change the outcomes. It means they're much cheaper as an export nation as they pivot towards a robot nation because they don't have any population. They're shrinking. So, okay, that would be a great game changer for Japan, but it means everybody else would have to look at doing something similar because the Europeans are pushing on a string too. They're right at the end of their tether. How much further can they go? Because they own already most of the government bond market of Europe as well. So that's a huge issue. So gold really in this is the option on the end game. If the central banks hit the end game in this cycle, then gold goes up exponentially for a period of time as the world struggles with whatever the outcome is going to be. What does the future system look like? Maybe they find a resolution of that and then gold goes back down again. Fine, I don't really care about that yet. There's no point trying to yet think about what the final solution will be. Maybe the world can carry on with more debt and write it all off and nothing happens. Who knows? I mean, maybe the MMT crowd are right. And again, I'm not here to pass judgment on any of those. I'm just here to look at probabilities. That's why gold is going up while the dollar is going up. I don't think it'll necessarily keep doing that all the time, but over time, it'll definitely go up while the dollar goes up a lot. That leads me into, okay, if you're going to do that, if you're going to take that leap, that intellectual leap of there is an end game potentially approaching and that gold is an option, well, then what is Bitcoin? Bitcoin is also an option. It has some of the properties of gold, in which case it can protect you in a situation like this against an issue with money. Problem is really Bitcoin is far too volatile to be a store of wealth right now. So what is it? It's a lot of things and it's not one thing. And we all try and anchor ourselves on what we think it is. But what Bitcoin is, along with digitization, blockchain, cryptocurrencies, and all of the things we're seeing, including the new Facebook one, stable coins, ICOs, the whole lot, is this is a whole entire new financial system from soup to nuts being built in front of us. And I know people don't want to believe it and they can't see it, but I'm so convinced now that this is where we're going. And I'm not saying for a second that Bitcoin is the currency of the world's going to use. I think what Facebook did with their Libra was something much closer, which was a basket of global currencies, including the dollar, which means there's no denominator. The denominator, therefore, has to be probably inflation driven by money supply. It's a very simple format. It's like a closed world. It's like a monetarist dream. But that would be a global currency. And it was being issued by a private company, which is an extraordinary turn of events. Now, could it be issued by the IMF? Yeah, but who's going to stop? I mean, what can stop Facebook or Amazon or Alibaba or anybody issuing a globalized currency of that sort? Now, what's interesting about that one is it still includes the underlying currency. So it doesn't get rid of that, because many people said about cryptocurrencies, well, the governments are never going to agree to this because you can't pay your taxes in a cryptocurrency. Well, this whole Facebook idea allows exactly that. It allows the underlying currency to be there, but it allows everybody, including all world trade, to take place on a stable pricing platform. So, and Bitcoin is all part of that equation. It is one of the cleverest single things I've ever seen, because it solves enormous amounts of problems for the financial world that we have, including things like ownership and trust. It is really an extraordinary development, of which I don't think we even have the slightest idea of the number of applications that are already being built and where this thing is going. The world of digital value is something we're going to have to get our heads around, as we understand that digital assets have real value in the world as much as a piece of art has value, much as gold has value. If we ascribe it a value and it can be recorded forever on a blockchain, then it is a permanent asset. If it's a permanent asset, it has value. So that's what I think we're doing. And I think Bitcoin is pricing in its stock flow model, which there's a fantastic guy on Twitter called Plan B. His handle is at 100 trillion USD, or 100 TRN USD. He's built a stock flow model of very complicated mathematics, which is extraordinary, and compares all assets. It's like gold, silver, copper, platinum, palladium, diamonds, and Bitcoin. And they all exhibit certain stock flow models. So gold and Bitcoin are almost identical in how they look. Gold currently has a higher valuation than Bitcoin because of where we are in the stock flow, i.e. a lot of the new coins haven't been developed yet. And as we start drawing down on the overall supply of 21 million, the price goes up over time. On the other hand, it shows how silver has a stock flow model that's half industrial commodity like copper and half precious, which is exactly right. Same with palladium and platinum. So he's built this incredible flow. And diamonds, high-priced diamonds, look like Bitcoin and like gold, as we also kind of intuitively know. So that's telling us that this whole Bitcoin thing, if he's right, and it's been very right so far, and there's some deep maths and some great regression analysis, suggests that it's just going to keep going up until it gets to a $100 trillion market cap, which is basically, interesting enough, about the same size as the entire global capital markets. Not the capital markets, the entire global money supply. So there is a lot going on in this space, and it is all about the optionality of this, of a separate system being built in front of our eyes. So that was a long answer to a short question.
Oh, it's great. I mean, it's interesting food for thought. There's a couple of things, I mean, as we look at gold, you've started to see a lot of the big dudes come out in support of it at this point in the cycle. Ray Dalio was talking about it with his new piece. Paul Tudor Jones is talking about it. Historically, we've done studies. A lot of people have talked about this. When you either have negative real interest rates or flat or negative yield curve, tends to be a great time for gold for a lot of reasons historically. The thing about crypto is once everyone can kind of solve the plumbing and pipes and custody widespread where it's, accepted by the major banks or Fidelity, I know they're working on it, and you can get some ways to easily invest in a basket at a lower cost. To me, that's something I think you'll see the wide adoption. I don't know. Certainly will be fun to watch as all this plays out in real time.
And also, Meb, sorry, just a thought about this. So, look, we do have a dichotomy between different people's investment opportunity sets. So you and I are Gen Xers. Baby boomers, now they have to make that switch out of equity, out of the excess real estate, out of all of their investments into an ability to draw down income over time. So that tends to be fixed income is the way you have to do it. So their propensity is towards that. Our propensity is a bit screwed up because we've got really expensive equity markets and bond market that is not the opportunity it once was, apart from from the trading point of view that we've talked about. And it's a difficult set of things, but we still have a career. We have the ability to generate income, to run businesses and do that kind of stuff. And that's where we tend to be focused on that. The entrepreneurial journey seems to be our investment. And then on the other side, you're a millennial. You've come out into this world and you want to start saving. But do you pile your money into equities at all-time highs with an expected negative 10-year rate of return? No. Do you want to accumulate bonds for the next 30 years into retirement? Clearly not. Do you want to buy property? Well, property prices are very expensive and basically you can't afford it. So until we fractionalize it using Bitcoin or something else, cryptocurrencies and fractionalize, ownerships of stuff, there's no way. Now, once you fractionalize it, you can turn things to incredibly more expensive valuations. But right now, they have no opportunity set available to them. So let's say you've got Bitcoin. Now, maybe you're a cynic and you say, okay, fine, I'll put 10% of my portfolio in. If we're right and it goes to up 100x, well, it becomes one of the greatest investment opportunities. And it's basically like being given equities for the baby boomers in 1982 with a PE of 8, or being given a bond market in 1982 to the baby boomers, what they got, and they got a PE, they got bond yields of 17%. They had a gift of wealth generation. They kind of screwed it up because they borrowed too much money. We, as Gen Xers, we're in the middle of all of that trend. We never got any of that skill set. But in the end, we realized that, and we had enough youth left in us to go to make up our income sources elsewhere. But the millennial, I think, why would you not choose Bitcoin? Why would you not choose that option? Because if it goes to zero and it's only 10% of your savings, I mean, it's irrelevant in the longer term scheme of things, and your equity bond and other valuations will probably have some return that's okay. And so it's that. But if it goes up 100x, it makes a huge difference, or maybe it goes up 1000x, or whatever the number is, because it's a kind of exponential return function right now. So I just think I don't see any reason why it would not get adopted.
Yeah, my only comment on that is that 100 times out of 100, this is me personally, I would rather invest in a basket of 100 startup early stage companies. And some of those could be companies building out the whole crypto space, and eventually if crypto gets big enough, all those companies will eventually be a part of, I don't know if it'll be a part of the traditional equity market, but a part of some global market cap, of all the investable assets. But the challenge for me is the sizing on that. I used to joke with, back when the peak of sort of crypto was going on, I guess that was January 2018, we were getting a lot more inquiries from friends, and they would say, Meb, I'm interested in crypto. What's your opinion? I say, I'm supportive. I'm a cheerleader, but I'm largely agnostic as to actual investing or not. They say, well, look, I want to do it. How much should I put as a part of my portfolio? And I said, why don't you do as a percentage of the global market cap, which at that time was probably 1%. Maybe it's now 0.1% or 0.10%. I don't know. But I said that way, along the lines of what your thesis was, if it grows, you don't really have to rebalance the market cap. If it becomes 5, 10, 20%, fine. You've participated in that exponential upside. And if it goes from 1% to 0, then, well, it's no big deal. So it's interesting. It'll be fun to watch.
That makes total sense. And I too, like you, think that the VC space, okay, we're probably at the peak of cycle in VC right now. But, I think the opportunity set with technology and the rate of change of almost everything around us is so high that VC remains an incredibly attractive proposition over time. So, of course it's cyclical. I think with VC, you probably need a bit more skill set, experience-wise, because you need to understand businesses and business models and that kind of stuff, which again, generationally tends to suit somebody who's had a bit more experience than somebody who is 28 years old.
Yeah. What we talk a lot about on here is you say, look, if you're going to do angel investing or private investing, and there's a lot of wonderful platforms like AngelList, et cetera. Now you could do it for $1,000 probably per company. So you really got to diversify across probably 30, 50, 100 companies and do it with a 10-year allocation period. Meaning if you're going to put in $100,000, you're going to do it $100,000 every year or $10,000 every year, whatever it may be, for the next 10 years and commit to that now. Otherwise, what's going to happen? Well, if and when we go into the next recession, bear market, most people will just stop allocating. And that's often when a lot of the best opportunities come up. The multiples will come down, you get a nice washout, and then you just keep allocating. So that having been said, I live in Los Angeles, so we see the flip side of a lot of the potential good flow, which is restaurants and movies that everyone wants to invest in. Those they can be good investments, but a lot of the crowdfunding sites too, it seems to all be craft beer companies. And I love craft beer more than anything on the planet as a consumer, but it seems like, and there's been some big exits, but it seems like almost everyone is some sort of a craft beer company. I don't know. And the nice thing nowadays is that like the AngelList, we've had Jason Calacanis on to talk about this, where you have some great screening
And for me, the helpful part is to get to a company that has actual product market fit with like $500,000 or $1 million in revenue, because the biggest attrition seems to be when you just have an idea. And that's not to say that half of them aren't going to fail anyway. It just means that there's something there. Maybe. Who knows? Raoul, we're going to start winding down. Last time you were on, we asked first-time guests a question, which was, what's your most memorable investment? And you talked about that. So this time, I want to flip the mic around, because you asked me this when we were in the Caymans a couple years ago. And the question is, what's your best idea right now? I said at the time, this was into 2016, said emerging markets. Last time you were on, you definitely talked about Greece as one idea, I remember, which has had, it may be the number one equity market so far this year, but certainly has had some strong returns over the past couple, but has been an interesting one. I think we know the answer, but let's put it to you. What do you think is your best idea right now?
Buy bonds, wear diamonds.
That's great. And before we let you go, I have to ask you one more question, because it might be my favorite thread of the summer. You kind of really dangled it on us, where I think you were stuck on the tarmac, leaving or heading to the Caymans, I can't remember which, and you sent out a tweet with something like the lines of, I'm waiting on a flight, so I want to give you a story of the greatest macro trade I've ever seen. And then just ... And I think maybe the plane took off, or you got stuck, lost internet. But can you tell us that story? Because I think it's a really fun one.
Yeah, that story is exactly pertinent to what's happening now, which is why it's such a phenomenally good story. And it explains the power of the Eurodollar market. And it explains the power of capturing that trend when the economy starts slowing, and understanding what is the true trade, the one trade that beats them all, and filtering all the noise. And that's what made it so phenomenally good. And it taught me a big, big lesson. I was at the time, this was going back to 2000. I'd left Goldman Sachs, where I was running the hedge fund sales business in equities and equity derivatives. And I'd gone over to a hedge fund, and I was learning my way about running a book. And I was typical as a salesman going into a hedge fund, over trading in everything, because it was like being given, a kid in a candy store. And I hadn't really understood what makes the great trade. And then I hear from a friend of mine about a guy at one of the biggest hedge fund firms in the world. He was in London, in their London office. Well, it was outside London. And the Fed cut rates, just like they've just done. And it was on January the 3rd, 2001. Most people weren't in the office, but this guy drove into his office, saw what was going on, had just been given his new risk limits for the year, and he went extraordinarily limit long of Eurodollar futures expiring at the end of that year. So this is kind of what we've just seen now. We've just seen the first cut. So what happens? Exactly like now, Eurodollar futures explode. Even though they've been pricing in a cut, they start saying, Fed don't cut once, they cut lots of times, and you're in a business cycle, so rates are going to get slashed. So this guy, who shall remain nameless, got on a plane and went to his house in Mallorca in Spain, and he didn't come back. He just did one trade, and he stayed, never coming back to the office until he was up about 250 basis points. So that was an enormous move in interest rates. He had his biggest year ever. He was the biggest profit generator for the giant hedge fund he was working at. And suddenly rates backed up 75 basis points in a huge bloodbath. So he gets the phone call from his boss, who's one of the most famous hedge fund managers, if not the most famous hedge fund manager of all time. Calls him up, says, I'm coming to the London office. Can you fly back? I want to meet you. So tail between his legs, he heads back off to the London office from Spain. And his boss says to him, looks him in the eye and goes, right, you're up the most of any person in this firm. You're the largest driver of profits. You've just given a ton of money back, but you're still up huge. What do you want to do? And the guy looked at him and said, I want to double up. And the famous hedge fund manager said, do it. He beautifully recognized when somebody was absolutely on his game. The guy doubled up his position. So now he's twice the amount of risk he'd ever taken in his life. He had the largest single position at the firm by a huge amount. He gets back on a plane and pisses off back to Mallorca and does nothing again. In November, after the Fed had been cutting and cutting and cutting rates, the equity market had collapsed 50%. He gets back on a plane, flies back into the office, closes his positions, makes, I think, $200 million for himself and retires. And that was it. And the beauty of that trade was him knowing that it was the knock-on effect of understanding the Fed have cut. The Fed are going to cut a long way. They need to. The equity market's going to make them cut even more because there's a huge bubble there, and the Fed are going to have to try and offset that. So don't even bother trying to short equities, which are volatile. Don't bother trying to do anything else. Don't bother trading any single instrument. Just by the front of the curve, you know what's going to happen. And when there is the inevitable over-positioning panic that maybe something's changed, that's when he had to take the one other brave decision, which was to double up. And that was just the best trade I've ever seen in the world.
And now he owns the entire island. Well, I think there's some really instructive parts about that, lining up your trade time horizon with actually how long. I mean, how many of us would have sold that every piece of the way once you made some money? And we've had some guests on the podcast. I mean, Chris Mayer was talking about 100 baggers where, these big, massive stock wins over the years, but you actually had to hold them in many cases 5, 10, 15 years.
So hard, Meb. I mean, I tried with Bitcoin. I had it from 200 to 2,000. I thought I was a god until it went to 20,000. And I felt like a complete chimp. And it's really hard to do. One of the great pieces of advice I got in my career was from Paul Tudor Jones, who said to me, Raoul, the best traders he's ever seen match their trade time horizon with their idea horizon, which is what you just mentioned. And this guy had a clear understanding of where he thought rates would be at the end of the year, and that's what he traded. And everything else he filtered out. That was genius.
You've been a money manager, also a writer for a long time, but also probably the hardest, I imagine, of all the careers, an entrepreneur. Catch us up with what's going on with Real Vision. One of my favorite properties. We're a longtime consumer, have loved watching the business evolve over the years. What's happening? And you guys, every time I hear you start hiring more people and get better and better guests. What's going on in the world?
Yeah, we haven't had you back for a while. We need to get you back on.
I'm a quant. I just spit out the same stuff every so often. But yeah, tell me about the biz.
But people don't understand quant, and I think it's a really misunderstood part of the market. And I think the more you could do for that, the better, because there's so many people who just write it off and say, well, it's the machines, they're going to screw up. People have no understanding of what quant really means nowadays. So I think it's important you come back on. That's a sidetrack. The entrepreneur's journey is the hardest bloody thing I've ever done, but it's also the most rewarding, as you know. And Real Vision it's almost 5 years old. It will be on September the 3rd, I think it is, September the 5th. Real Vision's journey has gone from 4 co-founders in our houses scattered around the world to a small office in the Cayman Islands where we're based, to now a global entity with people in most continents and 50 people in our New York office. It's been an extraordinary journey where we had the vision to democratize the very best financial information, use video as the medium, and basically create the Netflix of finance. From that vision to us having, 45,000 subscribers and enormous growth, and seeing how completely passionate everybody is about us. Yeah, I mean, you can Twitter every day how much people absolutely love Real Vision because we've given them access to people like you, just us having the conversation saying, hey, listen, Meb, can you come in and explain to people how quants work? That is just not accessible for anybody, but we can do that with Real Vision, and they can get to understand things from the very best people in the world at what they do. So it's an extraordinary thing where we have Stan Druckenmiller telling us how he makes money, how he thinks about trades, what setups he looks for, everything he thinks and he's learned about money management, all of that from the greatest ever trader investor in our entire lifetimes. Well, that's priceless alone. And it's only $180 a year. But, we've been growing as well into a number of different areas. We've been hosting live events. We have kind of this elite membership business where, we're hosting events around the world. We've got one in the Cayman Islands coming up. We've had, events in New York. We also have had kind of workshops where we help train people and educate them in things that they need to know by using, really good traders to help them with that process. One of our big ventures now is we've launched a free site as well. So it's called Real Vision Free, and you can find it realvision.com/free. And there is about 20 to 30% of our entire content is not behind the paywall because we don't want to limit it to people who can just pay. We want to let everybody get access to the very best financial information. And so that's a big drive for us to push forward, to get our name out there, to grow our audience, to make sure that people are engaging in finance at this very important juncture where it's possible that we go into recession and people need to be aware and need to be understanding of the risks that they're taking. So yeah, that's where we are with Real Vision. It's all very exciting. So if anybody's listening and they don't really know Real Vision, just pop over to realvision.com/free and there's the free version. Or if not, realvision.com, sign up for a free trial and have a look around at what is an incredible resource.
This concept, something that's been eating at me for many years. The podcast listeners are probably sick to death of hearing about it, where our educational system in the U.S. doesn't require or teach any form of not just investing, but personal finance, and wonders why, we have politicians wonder why we have such problems with student debt and people struggling with just very basic personal finances. It's a lot of it's never taught. And so many have been blessed with either the interest to go do it or the family to kind of craft that. But we've long talked about this. This is the you have a much better phrasing within Netflix of finance, because I used to say the Rosetta Stone of investing, where you have these topics, and the thing that I think could really catapult you guys is if you, on the free side, you kind of categorized it almost into like coursework. This is a 101 level. You want to come, here's the videos you watch in order, and then once you graduate from that program, hey, you want to go learn about security analysis here, you want to learn about commodities here, and that way it gets like a daisy chain of consumption of all the ideas. Because I know a lot of people that I love all the content on there. It's one of the benefits of Real Vision. It's kind of like what do you watch next? Where's the next best thing? So I'm excited. I've loved watching y'all's journey. So listeners, check it out. It's a lot of fun.
And you're right. I mean, sorry, just to go back quickly about that point about content organization, I think there's a journey of discovery for people and the knowledge. So we're just in the middle of starting to build some sort of basic AI content recommendation engines, so people can put in the kind of level they are, what kind of topics they're interested in, so people get a unique experience. Because we've now got 1,500 videos in our back catalogue, and we produce 3 new videos a day. So it's a fire hose of information. So we're just trying to make it easier for people to digest as much as they need or want.
Raoul, this has been a blast. You mentioned it. What's the best place to track you?
Yeah, best place by me is on Twitter. I'm very active there, and I'm very happy to engage with people. So it's at Raoul, RAOUL, GMI. GMI is Global Macro Investor, which is my research business. So find me on Twitter, hunt me down. I'm more than happy to chat, engage. If you've got any feedback on the podcast, I'd love to hear from you.
Listeners, remember, buy bonds, buy dollars, wear diamonds. Raoul Pal, thanks for joining us today.
Thanks, Meb.
We're going to add all these show notes at mebfaber.com/podcast. You subscribe to the show. If you guys got any feedback on this or any ebepisode, feedback at themebfabershow.com. Leave us a review. We love to read them. Subscribe to the show on iTunes, Radio Public, Breaker, anywhere good podcasts are sold. Thanks for listening, friends, and good investing.